60-day test period of this truce is completed successfully.
And you talk about that 60-day time frame, Dan, for very good reason. What happens as that 60-day time frame comes into closer focus?
Well, we're now on day 2 of that 60 days. What we expect to see in the coming days is the Lebanese military, the Lebanese armed forces, deploying throughout southern Lebanon. The Israeli military, which is still in its positions in southern Lebanon, having entered on October 1st, then disengaging, slowly withdrawing, with a view to fully withdrawing when that 60 days is complete. In that time frame, the Israelis will want to be convinced that the Israeli military, that UN peacekeepers are fully deployed, are fully asserting their authority, to the degree that Israelis actually want to see them gathering up whatever Hezbollah weaponry they might come across, shutting down whatever Hezbollah installations they might come across. So this is a test period that's going to be watched very closely, not least by the sides, but also by a number of foreign monitors, the United States, France among them. There is a mechanism that's meant to relay complaints, communication between the sides. It's worth remembering that Israel and Lebanon, the state, are technically at war. Israel and Hezbollah have been at open war. So really, there's a lot riding on the 60-day period, a lot of moving parts. For now, the truce appears to be holding. Time will tell if that will continue.
Okay, yeah, indeed. With the analysis then on the ground for us in Jerusalem, Dan Williams, thank you very much indeed. Let's stay on this story then and bring in the expertise of Jane Kinnamont, Policy and Impact Director at the European Leadership Network. Jane, if we're looking for bright spots in this region, is the ceasefire between Hezbollah and Israel a potential template for a ceasefire between Israel and Hamas?
In a word, no, but it does signal that Iran is interested in trying to have some constructive diplomacy with the incoming Trump administration. I think it's about that more than it having direct implications for Gaza. The ceasefire in Lebanon wouldn't be possible without Iran acquiescing it in the background, because Iran is Hezbollah's main backer. But Hezbollah has suffered greatly in this recent round of war. It has really punctured the myth that Hezbollah had built up over the years as supposedly a near invincible force. And I don't think, for that reason, they will be in a rush to break the ceasefire over the next 60 days. At the same time, there's very little direct knock-on effects in Gaza. We've already seen that the outgoing Israeli defense minister seems to have been saying there's no real reason to be fighting Hamas there anymore, and yet that part of the conflict drags on because there's no endgame. For Lebanon, there has been an endgame based on the UN Resolution 1701 that was referred to in the discussion. Everyone knew where it should get to. It was really about implementation. But with Gaza, there's a strategic vacuum because most of the world believes it should be part of a Palestinian state, but the Israeli government won't countenance that. And there's no serious proposals for how Gaza should be run, except apparently continued Israeli military occupation.
Okay, so huge question marks still about the fate of the people of Gaza and that conflict, of course, between Israel and Hamas within that land strip. Jane, but you do see a little bit more clarity in terms of the evolving stance of the Iranian leadership as they look ahead to that incoming Trump administration. How do you see that relationship then evolving with Trump taking office towards the end of January? Do we have clarity, indeed, as to what incoming President Trump's policy agenda is when it comes to Iran?
I think, like many areas of foreign policy, it is quite unpredictable because, on one hand, we know that under the previous Trump administration, he tightened economic pressure on Iran. He also ordered the killing of IRGC leader Qasem Soleimani, one of Iran's key foreign policy figures who was really responsible for leading relations with groups like Hezbollah, Hamas, the Houthis, etc. So, you know, the Iranians have had very difficult relations with Trump before, and he left the JCPOA nuclear deal. But at the same time, they know that he's someone who prides himself on being a deal maker, and he doesn't want the US to be tied up in long conflicts overseas. So right now, we are seeing Iranian people who are close to the government sending signals. A former Iranian government spokesman just published an article saying Trump has an opportunity to make history and end 40 years of US-Iran hostility by reviving the nuclear deal. We've also seen that Elon Musk recently met with Iran's ambassador to the UN. So there is a lot of activity. But as with many areas of foreign policy, including Ukraine, it could go either way. There's a flurry of interest in diplomacy, but also high risks that those efforts could fail.
Yeah, and particularly when we reflect on the fact that, at least according to intelligence agencies in the US, Iranians, at least Iranian agents, have had some role in attempted assassination attempts of incoming President Trump. When it comes to Saudi Arabia, the role of Saudi Arabia, Jane, is there? This was the president, of course, who was the architect, him and his team, of the Abraham Accord. Is there a place for Saudi Arabia and diplomacy, official diplomatic relations with Israel under this incoming Trump administration?
Again, I think that the story here is about Saudi Arabia and Iran, while everyone focuses on Saudi Arabia and Israel. I think that the Saudi government is keen in the long term in having normal relations with Israel and with every country in the region, but it is too difficult politically with their own population for them to do that right now. Both with the conflict in Gaza, but also with an Israeli government that is openly talking about annexing the West Bank. The Saudis have said many times there needs to be at least a credible pathway to a Palestinian state. That's not there right now, so it's very difficult to move. But something that's really changed since the last Trump administration is that Saudi Arabia and Iran are no longer at each other's throats. So if there is to be revived nuclear diplomacy with Iran, MBS, the Saudi Crown Prince himself, could play a key role. We know that he has Trump's ear. We know that he has good relations with Trump's son-in-law, and he can speak directly to the Iranians. So we may see him playing a role of go-between, which has no precedent in the previous Trump term.
Jane, we switch focus to Asia, if we can, and the focus on China, Taiwan. We have again the incoming president with a team of China hawks, pretty notable China hawks, but also someone who's been in the past pretty ambiguous about support or lack of support for Taiwan, and obviously an individual who suggests that he is a peacemaker, arguably, that he's going to play that role when he's in office. How do you see the relations between the US and China evolving?
Well, what I'm hearing is that there's a lot of nervousness in China just now, as you might imagine. But the key concern for them is really about trade and tariffs. What are the risks that if Trump goes through with his plans to have tariffs, that could then have very damaging effects on China's economy? That is the major strategic issue for them. They also get worried when they see that the US analysts are often casting them as part of a new, axis of evil or axis of upheaval, some people say, pairing them up with Russia. They don't want to be seen that way. They want to try to have a better relationship with the US. But I think Taiwan is worried too, because its security depends on this concept of US support, US extended deterrence throughout the Asia-Pacific region. And everybody, including the South Koreans as well, are wondering, how much will that support be forthcoming? There's very different views within the Trump camp about whether America first means sustaining America's primacy as a superpower, or whether it really means focusing much more at home and seeing issues like Taiwan or Ukraine as regional conflicts that aren't the direct business of the US, in sharp contrast to the past.
Jane Kinnaman of the European Leadership Network, in terms of the geopolitical lens on Asia and the Middle East, with the insights there and the value that we have for our viewers in terms of trying to unpack potential scenarios. Thank you very much indeed for joining us this Thursday. Coming up, Nouriel Roubini is talking of Donald Trump, about Trump's proposed tariffs. We heard their view on how China is nervous about the prospect. Listening to part of our interview, that is coming up next. Stay with us. This is Bloomberg.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them. Did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger. But drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that. We'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the fire line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
He wants not only to make all those tax cuts permanent, but he made other promises. No taxes on tips, on overtime, on social security, on income earned abroad, and so on and so on. It's estimated these things may add to the deficit by $8 trillion. Too much demand, inflationary. He might want to weaken the dollar. That's going to be inflationary. He may interfere with the independence of the Fed. Getting out of the Paris Accords is going to make climate change much worse, increase food prices and things of that sort.
It's interesting, Nouriel, a lot of things you just said are what a Bitcoiner would say as to why you should buy Bitcoin. There's now the Bitcoin ETFs. They're over $100 billion, clearly a big hit. There's talk that it could be a strategic reserve. You have gold in the portfolio. Is there anything that could move you to add Bitcoin to your ETF to help accomplish some of these goals?
You know, the Bitcoin is highly volatile. It can go up by 10% one day and down 10, 15% another day. If you want to have a stable store of value, you would not put Bitcoin into your portfolio. The kind of assets we're actually thinking about are all assets that do well when you have lower growth and you have higher inflation, whether it's tips, short-term treasuries. Gold is a hedge against inflation, debasement, de-dollarization, geopolitics, financial crisis. Some exposure to ag commodities that are going to do well in a world of inflation and of climate change, and environmentally sustainable REITs. So it's a diversified portfolio of assets that historically have done well in these types of tail risk. I'm skeptical for lots of reasons about cryptocurrencies and Bitcoin because they're not currencies. They're not a unit of account. They're not a scalable means of payment. They're not a stable store of value. And if you want wealth preservation rather than high volatility, you want to stay away from those types of assets.
Okay, that was Nouriel Roubini, of course, of Roubini Macro Associates with Bloomberg's Eric Balchunas. And that conversation, of course, started on the question of the tariff threat coming from incoming President Donald Trump and his administration. For more on that story, let's bring in Brendan Murray, who leads Bloomberg's trade coverage with a lens then on what is unfolding when it comes to the question of tariffs, the implications and the impact it's already had. We saw a pretty volatile Mexican peso in the session today as we passed comments from both the Mexican leadership and Trump in light of a conversation that was had. What is our understanding of the motivations of President-elect Donald Trump? Do we get day one tariffs, or is this a negotiating ploy prior to him taking office towards the end of January?
Right, yeah, like you said, it's been a real roller coaster week, starting with those tariffs that the president threatened on Canada and Mexico. I think what we saw was sort of a preview of what's to come in the second Trump administration. You had Mexico staking out a much more defensive position than Canada did. Mexico said, "Look, these are American companies are all over Mexico, and you're just gonna hurt yourself if you put tariffs on U.S. Mexican exports to the U.S." Canada, on the other hand, took a more diplomatic approach. They got on the phone immediately, started saying, "Hey, look, we're not the source of the drug problem or the migrant problem. That's Mexico." So the end result was Donald Trump got to post on social media last night that he had a deal with Mexico. They're going to close the border. Mexico's president took issue with that and said, "Well, we don't close borders. We build bridges." So I think what you saw this week in this episode was a lot more negotiating tactics by the president. After all, 25% tariffs on the U.S.'s biggest trading partners would crush the U.S. economy, frankly, and it would particularly the auto industry, which just the manufacturing states just helped him win the election. So whether it's a negotiating tool or not, we'll see. But that's what it feels like at this stage.
And these three nations operate in a trading pact that was renegotiated by Trump when he was in office the last time around. What are the implications? Is there any sense that they're going to look at that, rewiring that again, NAFTA Mark II, NAFTA Mark III? What is the state of play when it comes to that trade agreement between these three countries?
Well, if those 25% tariffs were to be imposed, there would be lawsuits, lining outside the White House because of the USMCA and because of this free trade zone. So effectively, 25% tariffs would blow a hole in that agreement and raise a lot of legal questions about whether the president can do that or not.
Okay, Brendan, thank you very much indeed. Brendan, of course, who will be, along with the team, very busy, you would suspect, in the weeks, months and years ahead. Brendan Murray, our trade czar, our global trade czar, on the latest when it comes to the tariff threat from the incoming President Trump and the reaction from Mexico and Canada as well to that tension. Coming up, we're going to speak to Sonia Martin, DZ Bank, Head of FX and Monetary Policy, get a view on how to position in these markets, given concerns about tariffs, about inflation, and about a pretty uncertain path ahead for some of these global central banks. At least we've been hearing from the president of the ECB, Christine Lagarde, giving her views to the Financial Times on tariffs, but also, of course, we've heard from ECB speakers this week about the path ahead for the European Central Bank and core inflation, one of the key gauges out of the US that came basically in line with expectations. How does that adjust the view around the Federal Reserve? European stocks currently up 0.4%, S&P futures when markets return on Friday stateside, pointing higher by 0.1%. Nasdaq 100 futures looking to add 50 points. Stay with us. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries. The moment news breaks, 24 hours a day. Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
Welcome to Bloomberg Markets. I'm Tom McKenzie in London. Your top stories today: France's 10-year yields match Greece for the first time ever on rising concerns about stagflation and political uncertainty. Russia ramping up strikes in Ukraine, taking aim at energy infrastructure, and OPEC Plus delaying another meeting as the group faces concerns about oversupply in global crude markets. European markets, meanwhile, posting gains of 0.4%. On the benchmark stocks 600. We keep an eye, of course, on the politics of France, and we'll get you the details on that story. The government now suggesting they may be in the mood to compromise on the budget. Little bit of relief coming through for French debt, and I'll bring you a check on that shortly. S&P futures looking to gains of just shy of 0.2% when the US market reopens for a partial day of trading on Friday. Happy Thanksgiving to all our American viewers. Of course, markets closed, of course, stateside for Thanksgiving today. Nasdaq 100 futures pointing to gains of 51 points, up 0.2%. Let's flip the board and have a look then cross-asset. Keep an eye on euro-dollar. Of course, the CAC 40 in focus. I've mentioned that, but it's the French debt, sovereign debt, that is in focus. 2.99 right now on your benchmark 10-year over in France. Yields actually down 3 basis points, so a little bit of dip buying, given that we have heard some comments on potential concessions around this prickly subject of the budget. But clearly, a momentous day, given that the cost of debt in France hit the same as Greece for the first time ever. $73 a barrel on Brent, up 0.8%. Oil moving higher. Gold trading at 2,645, currently up 0.4%. Let's get to the story in France then and the details. French assets under pressure, as we mentioned, as the country faces a deepening political pressure crisis as well. Some of that pressure, by the way, easing, as we mentioned, when we look at the story of French debt. But for how long? A possible no confidence vote threatens to oust the Prime Minister, causing uncertainty and fueling those investor concerns. Let's get a check on the latest political situation. Bring in Bloomberg's Caroline Connor, our French correspondent, of course, for the latest. Caro, we have a vote then on pension reform and potential repeal of that consequential piece of policy that Macron pushed through at some cost. They're going to vote on whether or not to repeal that pension reform. That's going through today. Will it pass?
Yeah, I mean, that vote is mostly symbolic, but it's obviously heavily charged politically given the circumstances, because if the National Rally joined forces with the left wing, which actually proposed to repeal this pension reform from 2023, then that means this vote is going to pass. Even though it's going to be blocked later in the Senate, it doesn't vote very well if you have a no confidence vote against the Prime Minister over the next few days or over the next few weeks. As you were mentioning, what one comment this morning actually tried to reassure the markets. The finance minister, Antoine Armand, was speaking on the radio on RMC. He said he was ready to make some concessions, perhaps on the budget, in order to avoid a government collapse over the next few days. And this has had a slight impact on the spread between the French and the German 10-year bond markets, with the spread narrowing a little after these comments. Now, what kind of concessions we're going to see over the next few days? He said perhaps he's ready to kind of forget some tax increases and perhaps look for more spending cuts instead. But of course, spending cuts they're going to be found somewhere. And Michel Barnier has already promised 60 billion euros of savings in that next budget in order to bring the deficit from around 6% of GDP this year to 5% next year. So we'll see what kind of concessions that mean, and especially if these concessions are enough to please the kingmaker in the French Parliament, Marine Le Pen.
Well, on Marine Le Pen, Caro, what have we been hearing from Marine Le Pen? Is she ready to play ball? Has she seen enough to work with the Prime Minister to get this budget through, given the pressure on French assets, or is she going to play the wrecking ball?
Over the past few days, it seems like she was not exactly ready to make some concessions until actually Michel Barnier really listens to what the National Rally has to say. She wants, for example, no more taxes on electricity. She doesn't want any delay in the indexations of pensions on inflation. And she actually wants some spending cuts on immigration. Of course, this is a far-right party. Listen what she had to say a couple of days ago after she met with Michel Barnier.
If the budget stays the same, yes, this is not a surprise. We always said it for the past 3 months. I'm telling you, if this budget is not approved, the budget of last year will apply, and actually it's not as bad as this one, as there are less taxes for the working and middle classes.
Obviously, Marine Le Pen has her own agenda. You know, she wants to be a candidate in 2027 for the next presidential elections, and she has her own issues with this trial that she's facing for alleged embezzlement of her party at the EU level, and she's going to have a verdict on that in March. So lots of issues at stake here. The French, well, they're kind of divided 50-50 on whether Michel Barnier should stay after Christmas. One thing actually that they're punishing is their opinion on the French president, Emmanuel Macron. More than 60%, according to this ELAB poll, of the French actually say that Macron should perhaps quit if this Barnier government collapses.
Okay, well, we'll see if Macron takes heed of that advice. Bloomberg's Caroline Gunnar on the ground for us in Paris. Thank you very much indeed with that important update. Let's get some more perspective, particularly with the lens on the market reaction to the travails of France, but also a view on how central banks are thinking about the rate path ahead, and bring in Sonia Martin, head of FX and monetary policy at DZ Bank. Sonia, thanks for joining us. Let's start with France then. What are the linkages, in your view, between the political wrangling in France over the budget and the role of the ECB as we see inflation in Spain easing? Is there a link between the politics of France and the considerations right now by the monetary policy team at the head of the ECB?
Well, yes and no. I do think that, over recent years we have seen increasing interlinkages in between monetary and fiscal policy in the Eurozone, as obviously the ECB is the proud owner of a vast amount of government bonds from the EU states. So obviously that is an issue. I don't think currently what's going on in France has an immediate impact on what the ECB will be doing in December. The ECB is looking at a decline in inflation, it's looking at weak growth, and I think the predominant factor here for the ECB will be that they can cut rates in accordance with their price stability target. And I think for the time being, what's going on in France isn't at the top of their priority list. But of course, that could change should the situation escalate. But for the time being, I think they're going to focus on inflation and have an eye on growth, and that's their priority for the time being.
So, Sonia, do they go with 50 basis points in December, the ECB?
No, I don't think so. I mean, I know that there had been quite a bit of speculation, particularly after the last PMI data, which was weaker than expected. And so the market had sort of returned to the speculation that they're going to have to move faster, more aggressively. But I don't think there's any particular evidence that we have a majority in the council for that. I mean, obviously, you have the hogs still saying that we need to be careful. The doves are calling for more aggressive easing. I think the middle ground, 25 basis points, but combine that with the signal that rate cuts will follow consecutively at each meeting going forward. And I think that's as much of a dovish signal as the ECB needs to send right now.
Okay, that would be the dovish signal, the communication around consequential, or at least sequential cuts at each following meeting. You're still bearish on euro dollar, Sonia. We had Jeffrey Yu of BNY Mellon on the show earlier. He says he sees parity for euro dollar by the first quarter of 2025. It seems like you align with that view. Parity is now in focus for the single currency.
Oh yes. Absolutely. I mean, when we started looking at the possibility of a red wave Trump scenario in April of this year, we put a euro-dollar parity forecast in that. So we have been sort of arguing that in case Trump wins the election decisively, that we will see parity. And we have seen quite a big move already in the last few weeks. It has stabilized a little bit now. And I think maybe we're in for a bit of a wait and see period, because, there's a lot of noise coming from the US. And of course, the latest announcement that, Trump plans to implement tariffs on Mexico, Canada, and China when he takes office. It makes a lot of noise, but I think there's a time now where we have to just kind of wait until January, until he moves into the White House, and then we get a much better idea of what he's actually going to do. And so I'm kind of hoping maybe that we're in for a bit of a more quiet holiday season before things start kicking off again next year. And I think then we'll be heading lower, definitely.
Yeah, okay, so it's not fully priced yet in terms of those potential tariffs. As you say, there's still question marks about the form and shape and to what extent those are implemented. Where else is your lens when it comes to the FX space globally? I mean, the Mexican peso has been volatile for the reasons you mentioned. Are there some obvious candidates here where the pricing is still mismatched around the tariff risk?
Well, I think definitely even Mexico, I mean, the peso did recover some ground after the news that there had been a phone conversation between, Trump and the Mexican president. So there's a little bit of a, uncertainty of what's exactly going to happen. I think there's a feeling that we share that potentially this is just a threat for the time being, and that as long as Mexico takes some measures to appease Trump, maybe those tariffs won't come. After all, don't forget, all those pickup trucks that Trump's voters like to drive, they come across the border from Mexico. I don't think he wants to really make them 25% more expensive. I think in the currency space, there's definitely potential for a new adjustment, dollar strength to come through. And I think there'll be very few currencies next year that can actually beat the dollar in that environment, certainly in the first half of the year. Things get a little bit more murky when we look at the second half of the year, of course.
Okay, so there's still that dollar dominance story in the first half of 2025.
Yeah.
What expectations are you making then around the cautiousness of the Federal Reserve around dollar strength in the first half and that story?
Well, I mean, the Fed is in a little bit of a difficult position right now because on one hand, I mean, they have started cutting rates and they clearly intend to continue cutting rates. The question mark is how much time will they have? When is the window of opportunity going to close? And this is going to depend on when the tariffs come, because once they do come, that's going to have an impact on inflation in the US almost right away. So my sense is it makes sense for them to continue cutting now as long as they can, because they know that there's going to be an end to that. So there's no point in them now hesitating. I think markets have been speculating. They might pause in December. I don't see why they should. They have the opportunity to do that now. As far as dollar strength is concerned, well, I mean, Donald Trump has an interesting view on this. I mean, he likes the strong dollar because it sort of represents strength per se. Then on the other hand, of course, he wants a weaker dollar because of the export sector. So it's a bit of a mixed bag with him. I don't think they're going to interfere with it. Currency. They usually don't. The Americans have a history of having a strong dollar policy, but that's just verbiage. I mean, they're not actually doing anything to make it strong. So I don't think they're going to interfere with that. But the Fed will continue to cut rates, I think, for the time being.
Okay, the Fed continues. The window is open now, and you expect that cut to come through in December. And markets seem to be placing about a 6% chance of that happening. Sonia, before we let you go, a view on the UK, where markets don't see 4% or at least rates below 4% in the UK from the Bank of England until the end of the year, November. So this is, we have our own inflation challenges, we have our own services price challenge in the UK. Does that seem rational to you, or are markets underestimating a Bank of England that may have to go faster?
No, I think it's very rational. The inflation is proving to be quite stubborn, and I think it makes sense for the Bank of England to tread quite carefully. In fact, I think that, I mean, in a way, it applies to other central banks as well. I mean, you have to sort of balance the risks here. And so I do think it makes sense for the BOE to move cautiously. They'll continue to cut, but it won't be quickly and it won't be aggressively. And so actually sterling is one of those currencies that may be able to stand up to a stronger dollar because we don't have more aggressive rate cuts from the Bank of England.
Sonia Martin of DZ Bank with the analysis there coming through in terms of the FX space, with a view, of course, on the pound, the BOE's next moves, and parity for the euro dollar as well. That is and should be expected. With dollar dominance, once again, the story in the first half of 2025 is the expectations. Sonia, thank you very much indeed for your time. Coming up, Russia's President Vladimir Putin with a new warning aimed at Ukraine as the targets the energy infrastructure of that country in the depths, of course, of these winter months. We bring you the latest on that front. Stay with us. This is Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Season is here.
Third quarter earnings season, as we've been talking about, really in high gear.
Bloomberg is first to break the numbers.
We have some big earnings after the bell. Earnings from Caesars crossing the Bloomberg terminal.
Mondelez is reporting
Reddit, AMD, Snap.
Let's keep the conversation going.
With the smartest insights.
The bar keeps getting higher. 20% growth rate. When your comps get tougher, how much can you beat and raise?
Continuing coverage on Bloomberg. Context changes everything.
Welcome back to Bloomberg Markets. I'm Tom McKenzie in London. Happy Thanksgiving for everyone out there who celebrates it. European markets are right now up 0.4%, so some modest positivity coming through for European equities, and it's been felt most prominently in the tech space, with that sector up 1.6% across your individual indexes. Over in France, you are actually seeing gains on the CAC Grant up 0.5%. Here in the UK, the FTSE 100 is currently flat at 8,277. Euro dollar at 105. A little bit of pressure coming through for the single currency, down 0.1%. We continue to scrutinise the moves in the sovereign debt space of France after the cost of debt in France reached that equivalent of Greece for the first time. 298 right now on your benchmark 10-year. A little bit of move into that sovereign yield, or 10-year space, I should say, with yields down 4 basis points. Brent, $73 a barrel, up 0.6%. OPEC Plus pushing ahead, pushing forward, and pushing back their meeting, delaying that meeting. Gold gaining in the session as well, up 0.4%. Now, Russia is coming through with a new warning this morning to Ukraine. Russian President Vladimir Putin saying it could strike Ukraine's capital with new ballistic missiles. Bloomberg's Henry Mayer has been writing about this story and joins us for the latest. Henry, this was, of course, after the Russians used a new missile about a week ago in an attack on Ukraine. What is the latest in terms of this threat coming through from Putin and his acolytes in Moscow?
Yes, Tom. Well, I mean, what we've seen is that, Russia is responding to new attacks which have been made by Ukraine using ATACMS missiles supplied by the US. And President Putin today explicitly threatened to target what he called the decision-making centers in Kiev, which would obviously be a reference to the leadership of Ukraine. So far, what we've seen is, overnight, a massive missile assault on Ukraine's power infrastructure, about 90 missiles that were fired. That, of course, has been done by Russia in the past. So, the threat from Russia now is to use this new experimental intermediate-range ballistic missile again. We don't know how many there are in Russia's arsenal, but, we're in a period of escalation now, so it's a question of seeing, how far this takes us.
What is the ability for Ukraine to defend itself against these new missiles, Henry? What's our understanding of that ability for defense?
Well, I mean, if you're talking about the Oreshkin missile that was used last week, that's, pretty much impossible to defend oneself against it. Obviously, the other types of missiles that we use overnight, many of them were actually intercepted. Again, we don't know, how many of these missiles, these new missiles Russia has. Is obviously going to have to use them sparingly. And then, of course, we have the threat hanging there of a nuclear escalation. Last week, as you recall, perhaps, Putin updated the nuclear doctrine to allow for the use of atomic weapons under certain circumstances, including massive conventional attack by Ukraine. So, he's brandishing these threats on an increasing basis at the moment.
Okay, Henry Mayer, thank you very much indeed. As the escalation continues, of course, between Russia, Ukraine, and Ukraine's backers, of course. And let's stay on this story and get more details in terms of one of the Bloomberg Big Take stories of the day as well, because Ukraine is seeking more air defense, obviously, against that constant wave of attacks from Russia. The United States is the largest supplier of weapons, but Europe may have to provide more support under the incoming Trump administration. Bloomberg's Ros Manson joins me now around the set for the details on this Bloomberg Big Take, which is a fantastic deep dive into the data, the statistics around who supplies Ukraine, by how much, which parts of the military system are supplied, and the vulnerability of Ukraine should the Trump administration, incoming Trump administration, decide to pull some of that support. Just top line then, Ros, what have we learned in terms of how dependent Ukraine is on that US military support?
Well, those figures really set it out in a pretty stark way because, of course, Europe has been supporting Ukraine militarily, but primarily financially. And over half of the weaponry has been coming from the US, particularly missiles, rockets, and increasingly, as Ukraine runs low, artillery and ammunition. And it's very clear from that data that Europe's just not in a position to replicate what the US is doing. And we can see the Biden administration really trying to front run a lot of military aid into Ukraine, knowing that Donald Trump is going to be in the White House very soon and knowing that he's unlikely to support the continuation of military aid into Ukraine. And instead, he really wants to bring that war to a close. And so Europe is saying, well, we will have to potentially step up and in on this. But can they really? I mean, they've already got issues around their own stocks running low over the past couple of years. Production is not keeping up with that. They have to maintain their own stocks at home also. They can't just send everything they've got to Ukraine. And so, the production's not meeting that supply that's needed. And again, the high-level, missiles that are being fired now by Ukraine into Russia, for example, are, they're US-made primarily or from the UK. So the challenge is real. Europe may decide they want to step up, although Europe's not united on that front either, I'd note. But can they? Very unlikely.
What are the options that the Europeans are looking at? Is sourcing ammunition from other countries outside the European Union, is that something that's being considered? Is joint debt around the spending on infrastructure around defence? Is that being talked about more seriously? Could a new German government countenance that? What are the potential options at this point?
Yeah, there are a lot of challenges and options there. I mean, during the pandemic, we did see that kind of come together with joint funding. You know, you set up a joint fund and you push the debt on that down the road. There has been some talk about doing that. So you draw those funds together collectively, you use it to buy ammunition, including outside Europe itself, and you put the can down the road on having to pay for it all. But that again requires all the members of the EU, you know, really to agree to that, and that's very, very uncertain. And also Germany, as we know, has an allergy about how much they go in terms of their debt ratio, and that's been underpinning the recent government crisis that we've seen in Germany, and now an early election coming. So would Germany have the appetite to go there? That's also a big question mark. I mean, we are seeing factories that were idle for a long time, for decades across Europe, now being ramped up, you know, ammunition being produced out of some of these countries in the Baltic states, for example. And these were real, you know, bedrocks of supply during the Cold War. Ukraine itself, during the Soviet era, you know, there's a lot of expertise still in Ukraine about defense production, but it's size and scope here. And really the challenge is, can you do that in enough size and fast enough? And a lot of big defense companies, they say, well, yeah, we could do that, but we want guarantees around long-term contracts because it takes a lot of money to restart this stuff. And so there's lots of complexities there again about when or how this could be done.
So what is our understanding of the time frame? How long Ukraine can hold on if that support from the US, more than 50% of the weapons, the hardware that they receive, is withdrawn? What kind of time frame are we looking at, given that it seems, from your analysis, Europe is still not well placed to make up for that?
Well, the sense seems to really be that if the US fully withdraws support and Donald Trump says we need to have an end to this war, that we're talking months possibly before we get to some kind of negotiation. I mean, obviously through the winter there are already signs from today that Russia's starting to target Ukrainian energy infrastructure again, Vladimir Putin brandishing these bigger weapons, and that seems to be again about positioning Ukraine, positioning Russia for the reality that talks are coming. So we're probably talking at some point in the early half of next year, possibly, that we're going to get to some kind of negotiation. The reality is Ukraine would probably want to keep fighting, and they say they want to keep fighting, but if they run out of weaponry, they're going to have to get to the table, and that seems to be possibly, you know, 2025.
Okay, Ross Madsen, thank you very much indeed. Well worth a read. It is the Bloomberg Big Take with a deep dive analysis in terms of the challenge that Ukraine faces if that support from the US is withdrawn. Just the role that the US has played in terms of that military backing for that country up until now, of course. Plenty more coming up. We'll speak to James Athey, Marlborough Fixed Income Fund Manager, as European bond issuance hits a record, and the focus, of course, is on France. This is Bloomberg.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Welcome back to Bloomberg Markets. I'm Tom McKenzie in London. European markets, currently equities are up 0.4%, so a slightly brighter picture than maybe had been expected given the concerns about the French budget, but some of those concerns have been alleviated by assurances from some ministers that they are willing to negotiate. European futures and European markets are gaining up 0.4%, as I mentioned. S&P futures, US futures looking to modest upside of 0.1% after the losses of yesterday. Of course, the US is closed for trading today, reopening for a partial day of trading on Friday. Nasdaq 100 futures looking to add 51 points. Let's flip the board and have a look across asset. Euro-dollar in focus, as is French debt. The 10-year over in France currently yielding you 2.98. Yields are actually down almost 4 basis points, but they had hit the highest level that we've seen, at least compared to Greek debts, for quite some time. Euro-dollar at 105, down 0.1% on single currency. Brent is up 0.6, and gold is getting a lift as well, up 0.4% on the yellow metal. Let's bring in James Athey at this point, Marlborough Fixed Income Fund Manager. And James, if we can, we'll start with the question of France. James, if we get a budget that is passed, if we get a government in France that maintains and is able to continue to work, doesn't collapse with a vote of confidence, is there an opportunity to buy French debt?
Hey, Tom, good afternoon. Yeah, I'm sure a few people will see that as a trading opportunity. Obviously, we've seen volatility pop up a bit just in the last few days and some weakness, but it does appear that people are already willing to buy that, I guess, just on a valuation basis. We look further into the future than a day or a week or two, and on that basis we still have significant concerns. Obviously, in order to get a budget passed, there is going to need to be compromise in terms of the fiscal trajectory. And obviously the fiscal trajectory without significant adjustment is entirely unsustainable and a significant breach of various rules, particularly at the EU level. So it's a really, really difficult balancing act. Even if they can get this budget over the line, that assumes things are plain sailing for the next 5, 6, 7 years, because obviously any negative shock can have a deleterious effect on that budget trajectory. So we still don't see France as good value at 90 over Germany.
James, given that longer-term view then, and we'll move on from France, but just one more on what's happening in France. With that longer-term view, do you see a further repricing across the French curve then in terms of price down, yield up, as you think about those longer-term challenges?
Yeah, we do. I mean, if you look at how spreads in general trade in the European, in the Eurozone, they're obviously a credit component, and so they do generally tend to correlate quite well with credit spreads. And our observation of credit spreads would be that they are also incredibly tight, particularly given that in Europe, we're already starting to see the economy turn towards the sort of downstage of the cycle. So traditionally, you would expect spreads to be cyclical in that respect. So if we just get this macro picture, which is one of slowing growth, normalizing inflation to begin with, ultimately, I think we could see it, below target in Europe. Yes, sure, that allows the ECB to ease policy, but it does start to, suggest that there might be some asset distress within risk-facing assets, and spreads should widen. So idiosyncratic risk is not good at all, but we think the kind of beta risk, the correlation to credit spreads, is also negative here.
What assumptions are you making then about the cycle of cuts expected from the ECB into and through 2025, James?
Yeah, so I mean, at the moment, you look and we're priced to get about 30 basis points below roughly where the ECB sees neutral. So if the ECB thinks 2% is neutral, we're roughly priced to get to 1.7, and that's pretty slow. Now, lots of the ECB rhetoric at the moment supports that market pricing. But of course, if you look at sort of forward metrics that might influence inflation, that is things like GDP growth as opposed to spot inflation, which is pretty backward looking. I think the risks to inflation are definitely skewed to the downside. So if inflation ceases to be a problem for the ECB in terms of easing policy, then the growth outlook absolutely requires that policy is not just neutral, but easy, and probably significantly so. So we would say rates are definitely going to undershoot versus what the market is pricing.
Okay, rates to undershoot versus what the markets are pricing when it comes to Europe and the ECB. James, we have the jobs data out of the US next week. How consequential could that be in terms of expectations for the Fed? Is it still a split decision, do you think, when it comes to December, or are you leaning one way or the other?
Yeah, I mean, I really do. It does feel like a bit of a coin toss. We've had so much Fed communication over the last 3 months, which has contradicted itself. I think the Fed, like many market participants, has been led on quite a journey by data, which just continues to be really confusing, conflicting, confounding, and inconsistent through time. And the Fed has allowed itself to maybe get too far in either direction over the last 6 or 12 months. And I think they may have done that again in recent times. Certainly inflation data that we've seen recently suggests in the short term that maybe some of the sort of downside progress has slowed. But in an absolute sense, we're very close to target on PCE, and core PCE is not far from target, and a lot of those components that are keeping it propped up are really lagged in terms of how they react to economic conditions. So all of that should allow the Fed to ease, but you can't ignore the fact that a lot of the data continues to suggest that the economy is relatively strong. And obviously, looking further into the future, the Fed is worried that it could reignite inflation. So they're saying at the moment that they're quite equally balanced between the two sides of the dual mandate. I think inflation as it stands would allow them to cut, but if we get a really hot payrolls report, I think that could push them towards a hold. So it does feel like a coin toss. On balance, I think they will cut, but I wouldn't be able to say that with a high degree of confidence.
And of course, there's the uncertainty, isn't there, around the Trump administration's policy agenda and how that is synchronized, whether it's tax cuts or tariffs or that crackdown on immigration or illegal immigration. James, I was in a room with an event yesterday with a strategist who I won't name, but they said, look, what is being whispered right now in some parts of these markets is a question about whether or not the Fed at some point next year might even have to hike interest rates.
Yeah, I mean, it's a really interesting one, right? Because tariffs essentially should be a shock to the price level. That's not an inflationary process. Inflation is a process. Inflation is a general rise in the level of prices. It's not sector-specific moves in relative prices, which is essentially what tariffs predominantly will do. Of course, if tariffs were to increase certain input costs significantly, then of course you could see second and third round effects. Obviously, energy, oil, those sorts of things are significant in that regard. And so anything which is deemed to be a one-off shock to the price level, particularly when it's supply side driven, is something the Fed cannot control. And generally, theory says they should look through it. Of course, we've seen in recent years that the Fed's relationship and other central banks' relationship with the supply side has been very mixed, and they've really struggled to deal with some of these supply side issues. Of course, what happens in terms of retaliation matters. I think in terms of the labour market, I think here we're probably looking at the idea that supply creates its own demand. What we've seen is that the US economy has been propelled forward in terms of demand conditions by this immigration, and that's not necessarily been inflationary because it's been a supply shock as well. But first and foremost, I would anticipate that if people are being removed from the population, the initial impact is actually a drop in demand, and it might only be later that we would see that show up in wage costs. And again, that's a very difficult problem for the Fed to deal with. In terms of tax policy, this has to go through Congress. So if we look back at 2017, it was December the 16th before the Tax Cuts and Job Act was passed. And again, that was when Republicans had full control of Congress. And of course, that legislation is due to expire and so needs to be rolled over as a priority. So trying to tie that up with further stimulus presumably will make it difficult, even more difficult to get through Congress. So maybe the timing of that good news is a little backloaded relative to some of those more difficult to assess supply, tariff, and labour market policies. So it's very tricky, very tricky.
Very interesting, James. Before we let you go, how are you adjusting the portfolio before year end? What are you buying and what are you avoiding?
Yeah, so we've been using this rise in yields to add to duration. We sort of think things have gone far enough. Definitely, the predominant driver in our estimation of that rise in yields was just the better growth data out of the US. You've seen economic surprise indices rising in a 45-degree fashion, and it's notable to us that that's now started to roll over, and as it's done so, Treasury yields have started to come down. So we'd added a bit of duration. We've actually reduced our exposure to the US dollar as well. That's probably one of the big ones. We've been long the dollar, and since the summer, very much expecting that a rise in yields would be a sort of US-led exceptionalism-driven phenomenon. We think maybe in the short term there's quite a lot of good news and definitely heavy positioning along the dollar. So we've actually tactically gone the other way.
Okay, yeah, really interesting call on the dollar. Underweight the dollar, long duration. James Athey with the analysis and how to position maybe towards the end of this year. From Marlborough, really appreciate your insights, James, as ever. Thank you. Now, investors, of course, also remain uncertain, as we've been discussing, about the impacts of President-elect's Trump tariff threats, of course, with many concerned they could have adverse effects on the global economy. James was giving his view there in terms of how that might be sequenced and where tax cuts, for example, may come and where tariffs may land. Famed economist Nouriel Roubini, meanwhile, has warned that the policies, particularly when it comes to tariffs and a crackdown on inflation or crackdown on immigration, could lead to higher inflation and potentially lower growth as well in the US. Take a listen.
Some of the economic policies of Trump may lead to higher economic growth, being pro-business, keeping tax rates low, deregulating the economy. But unfortunately, many of the other policies are going to have an implication of higher inflation and lower economic growth. The first thing he has already announced is going to be tariff against Mexico, Canada, and China. And that's only the beginning. He has said we might have up to 20% tariff on all our trade partners, up to 60% against China. He wants to have massive deportation of people. In the last few years, the increase in migration has kept the lead on wage growth, has increased the labor supply, has increased economic growth. So definitely mass deportation is stagflationary. He wants not only to make all those tax cuts permanent, but he made other promises. No taxes on tips, on overtime, on Social Security, on income earned abroad, and so on and so on. It's estimated that these things may add to the deficit by $8 trillion. Too much demand, inflationary. He might want to weaken the dollar. That's going to be inflationary. He may interfere with the independence of the Fed. Getting out of the Paris Accord is going to make climate change much worse, increase food prices and things of that sort.
It's interesting, Nouriel, a lot of things you just said are what a Bitcoiner would say as to why you should buy Bitcoin. There's now the Bitcoin ETFs. They're over $100 billion, clearly a big hit. There's talk that it could be a strategic reserve. You have gold in the portfolio. Is there anything that could move you to add Bitcoin to your ETF to help accomplish some of these goals?
You know, the Bitcoin is highly volatile. It can go up by 10% one day and down 10, 15% another day. If you want to have a stable store of value, you would not put Bitcoin into your portfolio. The kind of assets we're actually thinking about are all assets that do well when you have lower growth and you have higher inflation, whether it's tips, short-term treasuries. Gold is a hedge against inflation, debasement, de-dollarization, geopolitics, financial crisis. Some exposure to ag commodities that are going to do well in a world of inflation and of climate change, and environmentally sustainable REITs. So it's a diversified portfolio of assets that historically have done well in these types of tail risk. I'm skeptical for a lot of reasons about cryptocurrencies and Bitcoin, because they're not currencies. They're not a unit of account. They're not a scalable means of payment. They're not a stable store of value. And if you want wealth preservation rather than high volatility, you want to stay away from those types of assets.
Okay, that, of course, was Nero Rubini of Rubini Macro Associates with Bloomberg's Eric Balchunas. Coming up, OPEC Plus delayed its meeting and is facing a dilemma over supply. Details on what is causing the friction at OPEC Plus and what it means, of course, for this global oil market. That is coming up. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big. With $1 trillion of assets almost, we're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Welcome back to Bloomberg Markets. I'm Tom McKenzie in London. To oil now, where OPEC Plus has confirmed Bloomberg's story that it is delaying its meeting. Let's go to Bloomberg's James Heron for the details. James, thank you for taking the time. We're looking at Brent up 0.4% so far in the session. There's a lot of different factors, obviously, feeding into the global oil markets at this point. But let's start with the OPEC Plus decision to delay. What do you and the team read into that decision?
Well, officially, it's because of clashing arrangements for the ministers, particularly the Gulf Cooperation Council meeting. But in the past, when OPEC has delayed a meeting, it's tended to be because they are still trying to find a consensus, trying to get everyone on board with whatever agreement is before the meeting happens. That way, at least they can avoid the potential for last-minute hiccups on the day of the meeting, or the worst-case scenario, which is where the meeting would end without a deal. So we're still trying our best to report out the details of what they're looking at. The current expectation is that they're not in a position to increase production as planned in January, and then they may need to delay that increase by several months at least. And this delay perhaps would suggest that whatever they are looking at, and we know that they have been discussing the possibility of a delay, that they don't quite have everyone on board for that yet.
Okay, that's interesting. So they may not even have the ability to increase output, even if they come to the decision that that is what they want to do. What is our understanding about the other challenges, James, that OPEC Plus is facing as we weigh up the kind of demand-supply picture?
Well, the main challenge is that because there is so much supply coming on next year, most of it from the Americas. The US is still pretty strong, but you've got Guyana, Brazil adding more supply. And demand is pretty weak because China's not growing as fast. The economy is not doing great elsewhere. And so even without any extra oil from OPEC, there's set to be quite a significant surplus next year, which could weigh on prices. And now if OPEC were to go ahead with its planned production increase, prices could fall even further, perhaps below the 60s from the 70s where they are now. That's too low for most OPEC members, governments to balance their budgets, to make the investments they want to cover social spending. So they're really stuck. They want to increase production, but if they do, prices could fall, and they can't afford that.
Yeah. Okay. So $60 a barrel. What is the discipline right now across various OPEC plus members in terms of sticking to their quotas and targets, and to what extent is that maybe a friction point as well that we should focus in on?
That clearly is a friction point. The main countries that have been failing to meet their production targets have been Iraq and Kazakhstan. And now we know in the last few days, because they announced it, that the ministers from Saudi Arabia and Russia have visited both countries. So obviously applying pressure for them to, improve their compliance with their quotas, to cut production. Because in the case of especially Iraq is overproducing from what it's supposed to be, and also failing to make compensation for previous overproducing earlier on this year. So there's a lot of pressure on these countries to cut back, but they have a very poor record of actually complying, even when they are under great pressure.
Okay, James Herron, thank you very much indeed. When it comes to some of the tensions at the heart of OPEC Plus as they make that decision to knock back that meeting to December the 5th. So we'll see what they come up with, given all those competing pressures across that cartel. To the AI space right now, tech and listings. Shares of Chinese driverless tech firm Pony AI, well, they fell in US trading at their debut. That's after an early pop. We spoke with the CEO and the co-founder, James Peng, about their growth strategy amid, of course, those rising tech and trade tensions between Washington and Beijing.
In terms of the sanctions on the chips, actually for us, it's nothing new. We have dealt with this for quite some time already. So for our strategy was and remains to be that we will diversify our supply chain. And I think as the more and more manufacturings of the chips coming out from either in China or rest of the world, we'll try to have more diversified supply chain to further de-risk our exposure to the geopolitical tensions.
Hi, James. This is Steve Engel here. We met, I believe, at the Beijing Auto Show earlier this year. And I did take a ride in one of your LiDAR and Pony AI-equipped Toyota robocabs in Beijing. I do understand that, you're a company that had some robo trials in the Bay Area, but also in multiple cities in China. So you kind of have, influence in both the United States and China, obviously. But what was the main questions as you took your company public in New York? What was the main concerns, if you will, of potential investors when you went on that roadshow in the United States with increased geopolitical tensions?
Surprising, actually, the geopolitical tension questions wasn't at the front and center of the investors, but rather the investors more focused on the economical side of the robotaxi, people are really interested in to figuring out when will be a time for the robotaxi to be actually large-scaled, deployed, and be profitable. So I think the good news is that people really believe in that 0 to 1 has already finished, and now it's the time for the autonomous driving companies to really go to the large-scale commercialization.
What does that look like exactly, James? Because right now you're operational in 4 of the top or tier 1 cities, but what does that actually look like, say, over the coming 1 to 2 years? I know that you're going to continue to focus your efforts primarily in China, but talk to us about the competitive pressures that you face there as well.
Yes, especially if you're talking about the next 2 years, our main focus will be on the tier 1 cities of China. And actually just this year, we also signed a deal with Beijing Auto and Guangzhou Auto to mass produce autonomous driving vehicles. So that means in the next 2 years, we'll have at least 3 models coming out of the assembly line will be launched into the tier 1 cities in China. So I think with the support of further support of the regulations and the residents actually get more familiar with our services, I think we'll have a much larger fleet, have a bigger coverage, and hopefully we'll be able to actually have a much larger scale commercialization.
That's James Bum, co-founder and CEO of Pony AI, speaking to Bloomberg's The China Show about that listing prospects for driverless cars in the US and in China. Let's check in on the markets right now. European markets are up 0.4%, so holding on to the gains. On an individual index basis, the FTSE 100 is up just 0.1%, but it's a better picture, a brighter picture over in France, with the CAC 40 up 0.4%, and over in Germany, the DAX is getting 0.6. So that's a broad picture across Europe. S&P futures also pointing to gains after some losses that came through for US stocks yesterday, up 0.1% for the S&P 500. Of course, closed for trading today, given its Thanksgiving, but will reopen for a partial day of trading on Friday. Nasdaq 100 futures pointing to gains, currently just shy of 0.3%, looking to add 54 points. We can look cross-asset as well. There's been a lot of scrutiny in terms of the selling pressure coming through for French debt. That story has ebbed a little bit right now, with yields currently actually down 4 basis points. So a little bit of money moving in to French sovereign debt, which had earlier in the session today reached a level in terms of yields equivalent to those in Greece. First time we've seen that on the budget angst in France. Euro dollar at 105, dropping 0.2%, so further pressure on the euro. A couple of our guests calling for euro parity in the next couple of months. $73 a barrel on Brent, currently up 0.6%. Gold gaining as well in the session. The yellow metal up 0.4. Coming up, Lawrence Alder-Baker, economist at ITR Economics. We're going to check in on the Black Friday sales picture, what it tells us about the consumer and the health of that consumer. Stay with us. This is Bloomberg.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter, because then I got left alone. And actually, I think out of that period, we started to create better art, because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality, because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race. And Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank.
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
Welcome to Bloomberg Markets. I'm Tom McKenzie in London. Now, France's 10-year yields match Greece for the first time ever on rising concerns about stagflation and political uncertainty in France. Lebanon's economy minister says the truce with Israel is an opportunity for peace. We bring you part of our interview coming up this hour. And retailers are bracing for record levels on Black Friday shopping tomorrow. We bring you an analysis and a deep dive on how consumers are feeling ahead of that event. Let's check into the markets right now. It's in gains coming through for European equities. Happy Thanksgiving, by the way, everyone out there who celebrates it. Currently upside coming through for European stocks. The US is obviously closed. For that reason, markets will be back and trading for a partial day on Friday. European markets up 0.4% despite the political angst over in France. S&P futures pointed to gains of 0.2% when they reopened for trading. Nasdaq 100 futures looking to add 60 points, up 0.3%. Let's flip the board and look cross asset. The euro is under pressure once again. A couple of our guests talking about euro parity with the dollar, potentially as soon as the first quarter of 2025. Euro dollar one now at 105, down 0.2%, and that pressure continuing then. French debt in focus, 298 is what's being yielded on the benchmark 10-year after the cost of debt in France matched that in Greece for the first time on record. There is a bit of a move right now into French sovereign debt, though how long that will last. Yields are down 4 basis points. Brent is up 0.5%. OPEC Plus pushing back their meeting till December the 5th, currently at 73.23 on Brent. And gold is gaining in the session, up 0.3%. The yellow metal seeing some further upside. Now, in the United States, Thanksgiving is underway and getting underway. Holiday shopping kicks off, of course, with Black Friday tomorrow. Let's bring in, at this point, Lauren Seidel-Baker, economist at ITR Economics. Lauren, thank you so much for joining us. What are you looking at this Black Friday in terms of the shopping season, the discounts, and the health and robustness of the US consumer?
Overall, our consumer is very strong. Even with the bite inflation is taking out of our wages, we are seeing increasing real income. So that is a higher purchasing power than our consumer has ever had in history. So I'm personally quite optimistic about the holiday shopping season. We at ITR expect about 3% retail sales growth this year. Now, I will say it's a shortened holiday shopping season post Black Friday, just due to a quirk of the calendar. Thanksgiving comes about as late as it could in the calendar. So only 26 days between Black Friday and Christmas this year, but we've seen retailers start their sales earlier. We actually saw even the October retail sales numbers came in a little bit unseasonably hot. So it seems like we've pulled forward some of that activity. I'm not too worried about the calendar causing a constraint.
Okay, so there's the calendar adjustment that we need to take into consideration. The consumer is looking pretty robust. What is the ability for some of these retailers to slash prices? What is the discounting that you're seeing in terms of the historical context of that? What are we seeing on the discount level?
Sure. So the new Black Friday shopping season, it looks different post-pandemic. We're not rushing into stores and fighting people for big screen TVs anymore. A lot of it is done online, so the e-commerce portion is certainly picking up. That makes it a little bit easier to compare prices. And what we're seeing this year especially is that retailers are doing discounts. Maybe Black Friday itself is not that ultimate low price, right? That's not the only day of the year that you'll get this sale. Again, we've seen them start earlier for that shortened season, but we're also seeing consumers be a little bit more savvy. We know what that price is when we need to pull the trigger. So I think there are two aspects of this, both the consumer looking with this higher inflation environment for those good deals, maybe looking even to trade down in quality by the store brand, not the brand name in some cases. If it means saving a few dollars, retailers are aware of that. And again, they're pulling forward to try to get those dollars earlier.
Okay, that's interesting. So maybe a bit of trade down and a more savvy, maybe a more savvy or more a consumer who's scrutinizing some of these deals a little bit more closely. Does that speak at all to caution, or is this just a consumer that is just willing now to kind of trade down a little bit to get more bang for their buck?
I think that's a big part of it. The consumer likes to say they're cautious. Anytime we see consumer sentiment numbers come out, recently those have been a little bit subdued. Now, the retail spending numbers don't necessarily match that sentiment trend. So I'm convinced that we as consumers don't always know how we will behave. We know in theory how we should behave. But this time around, again, with inflation, cumulative inflation, having done so much psychological damage to the consumer, I think the really smart retailers out there are the ones that have the good, better, best model. In this current business cycle, we are seeing the upper income consumer a little bit more protected. That's typical just in this inflation type of environment. So again, it depends where you fall on the income distribution. It depends, say, if you're a homeowner who locked in a low mortgage rate versus a renter who's feeling that inflation bite a little bit more acutely. Everyone has their own inflation measure, and so there's a little bit more disparity this time around.
That's really interesting, isn't it? The breakdown in terms of different parts of the consumer. Yeah, if you're reaching for a 7% mortgage, then that's going to affect maybe how you think about how far you're going to go. Lauren, do we have a sense as to how much of this is being whacked on the credit card? How much debt consumers are prepared to pile up as they look at some of these offers that are out there, or is there still a cash pile that the U.S. household can dip into?
Well, we do have higher incomes today. So wage inflation has been the stickiest aspect of inflation. So the good news from our consumer is that we do have some of that additional, again, wage growth to fall back on. Now, we have spent down some savings since our pandemic era peak, and we've also turned more to the credit cards. I don't like to look at the total amount of credit card debt. Instead, I'm looking at the share of credit card debt, what that accounts for of the average annual income. Today, that's about 14.6% for our consumer, which is rising generally, but we had such a low during the stimulus when a lot of our U.S. consumers took our stimulus money and we paid down that high APR credit card debt first. So made a smart move. It makes today's metrics look like they are worsening, which they are, but in all honesty, this is about as good as those metrics have ever been in history. So we're watching credit card debt. We still have very low delinquencies, still very low overall numbers, right? The sum total is a share of our income, but it is something to watch this season going forward.
What is your view, with that economist hat on, Lauren, of how inflation adjusts into 2025 and the breakdown, particularly when it comes to goods. There's been a lot of work done, of course, in terms of goods inflation or disinflation now that we're seeing in the US versus the services component of the basket. How do you see that story evolving next year?
So you're absolutely correct. The good side of inflation is very well in hand in the U.S. right now. It is the service sector, again, our very tight labor market, keeping wage inflation higher. That's why inflation overall is a little bit stickier. So as I look forward into 2025, if we do get policies put in place like, say, universal tariffs, that could affect the good side of inflation again, start to bring those numbers up. While the service side, our labor market is still very tight from historic levels. So I don't see much relief coming on the horizon. In fact, I think by the second half of 2025, we should expect to see inflation picking back up again. I think that's going to limit, first of all, how many cuts the Federal Reserve can do. So I am not expecting ultra low interest rates to return. But again, that's psychologically going to affect the consumer who's just heard inflation headline after headline, day in, day out for the past several years.
Yeah, well, indeed they have, and yet the U.S. consumer has showed that remarkable resilience. Is next year the year when that really gets put to the test, Lauren, or do maybe tax cuts from the incoming administration, maybe some other policy measures support an ebullient consumer, or when does that story start to really break, if at all? Do you see any friction when it comes to the pressure on this consumer, if there is that pressure? You pointed to some of it next year.
Sure. Yes, so there is pressure, but again, we are so resilient. Our consumer base in this country is in such a rock solid place, and it all comes back to that tight labor market. So if the consumer were to break, it would first take our labor market materially loosening. We have very high labor force participation, very low unemployment today. Again, those rising wages. Almost everyone who wants a job today can find one. We do see rising wages, so more people making more money. That is tough for businesses who are having trouble hiring still in some sectors. But for consumers overall, especially in the ultra tight markets like construction, this is the stable foundation. This is money coming in, again, with that rising wage inflation outpacing general consumer price inflation. That means that inflation isn't actually wearing down how much income we have. We're in a better place today, even if we do like to complain about those high prices on store shelves.
Before we let you go on the jobs market, because you've talked about the tightness in the labour market, are there parts of the labour market that are looking a little softer? Are there parts of the labour market where you're scrutinising, you're seeing the data and it's causing some concern? Or is this a broad stroke story of continuing labour strength?
Sure. So again, in general, the labor market is still very strong. We see some pockets, the tech sector, for example, we've heard recent layoffs in that front. Now, personally, I think the tech sector might have overhired. So in some ways, this might just be a right sizing of employment there. Areas like manufacturing have given up some gains in more recent months, but again, still very tight by historical standards. And as I mentioned, construction, that is the tight one. It is just so hard to find some of these very skilled tradespeople.
Lauren, thank you so much. Happy Thanksgiving alongside Al Baker, taking time out from the holiday of ITR Economics to give us a deep dive in terms of Black Friday, what we're seeing in terms of the retail space, of course, and the health of that still pretty robust US consumer, with a view looking to 2025 as well, of course. Speaking of retail, Bloomberg's Scarlett Fu and Romain Bostick spoke recently with Bloomingdale's CEO, Olivier Bron, about the holiday season and the future of the department store model.
The models in Asia and Europe right now are really flagship focused. So I think that's one big difference. And honestly, I think the flagships will have a bright future in the next 10, 20 years. It's not, I think, a problem at all. I think the problem here is managing such a large footprint. And that can be a challenge sometimes. At Bloomingdale's, we have the chance to be in prime locations and prime malls, so very strong locations. We have a limited footprint, so I think we have more opportunities than threats for Bloomingdale's in the future. I really do think that actually the department store model has a bright future, but it has to reinvent itself from the perspective of the customer, but also from our brand partners. We have to be relevant for our brand partners and rethink the model from this point of view.
How about the broader retail landscape overall? Are there too many stores in the U.S. overall?
When you look at just the pure market data, when you look at the overall market is actually slightly growing. The penetration of online is going up. So for sure, the average productivity of the square feet overall in the US is actually slightly decreasing. So yes, there will be probably some losers. It's why you have to challenge yourself and reinvent your model to remain relevant for your customers, but also for your partners.
I have to ask you, when you look at other retailers, and it doesn't necessarily have to be a direct competitor, who do you envy most? Like when you walk into their stores or you shop on their website, who do you just say, wow, they really got it right. I want to try to emulate some of this.
No, first, I really think that actually Bloomingdale's is doing that right. When I discovered the model, I'm sorry to say, but I'd say, no, but it's not the only, it won't be my only answer. But actually, honestly, I was very surprised by the level of engagement of the customer. The relationship that we're building with the customer and with our partners is actually good. And I think we can even do better in the future. But I think there's a lot of source of inspirations from our competitors, but also from other models right now, whether it's in terms of service, in terms of brand mix, in terms of events and activations. There are a lot of inspirations that are in retail and beyond retail. I don't want to give you any names, but I have a lot of source of inspiration actually in the US, but also abroad, which is another thing. I think we should not be too domestic focused because we're going to miss probably some good trends that are happening somewhere in the world.
And you think that maybe what we see abroad in terms of their approach to department stores and just retail overall, you think that's going to be palatable to a US audience?
I'm absolutely convinced about that. I think, we have to bring the best of both worlds, and I think this is where we're going to perform and bring something different for the customer. The customer is ready right now for something different, more inspiring, and this, we can get it from some of the countries or some of the other models in the world.
Okay, Bloomingdale's CEO, Olivier Bron, speaking there to the team about the outlook and the future of department stores. Coming up, the latest out of the Middle East, switching focus, and including new nuclear talks with Iran. We bring you the details. Stay with us. This is Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg. Earnings season is here.
Third quarter earnings season, as we've been talking about, really in high gear.
Bloomberg is first to break the numbers.
We have some big earnings after the bell.
Earnings from Caesars crossing the Bloomberg terminal. Mondelez is reporting
Reddit, AMD, Snap.
Let's keep the conversation going.
With the smartest insights.
The bar keeps getting higher. 20% growth rate when your comps get tougher. How much can you beat and raise?
Continuing coverage on Bloomberg. Context changes everything.
Welcome back to Bloomberg Markets. I'm Tom McKenzie in London. European stocks are up 0.4%, holding on to those gains. Here in the UK, modestly gaining, just 9 points so far, with the FTSE 100 up at 8,283. US stocks, of course, trading closed for the day for Thanksgiving holiday. They will reopen. Trading will restart on Friday for a partial day of trading. S&P futures pointing to gains of just shy of 0.2% after some losses on Wednesday for US stocks. Nasdaq 100 futures also in positive territory. Euro dollar down 0.2%. Some softness coming through for the single currency at 105. French debt in focus on the budget concerns. 298 is what's been yielded on the benchmark 10-year. And Brent also gaining in the session, up 0.6% at $73.24. Gold to the upside, up 0.3% on the yellow metal, trading at 2,645. Talking of oil, OPEC Plus delaying another meeting amid supply concerns on the global crude market. However, the Saudi Minister of Economy and Planning told Bloomberg's Jumana Pasechi he expects non-oil activities to increasingly contribute to the kingdom's economic growth.
This budget is a roadmap for long-term economic leadership. We can't transform in one budget cycle or two. This is a long-term journey that requires consistent work. In the past, when we started, we were trying to get our finances and financial management in order, so we focused on zero deficit. After that, we realized that a deficit by design in a stable region between 2 and 3% is good for investing in the right economic sectors that we want to bring forward. This is about quality, non-oil economic growth.
I noticed that spending in 2024 actually came in 7.5% higher than what you had originally anticipated. What guardrails are in place to ensure that spending doesn't overshoot once again in 2025?
We're very conservative in our estimates for revenues, so that helps us. We are also year after year testing with more fiscal rules to help keep our spending within specific ranges. However, there's always opportunities for us to advance progress that we're seeing in non-oil sectors or priority sectors that are seeing more growth than planned. And decisions were made in the past, not just this year, but before, to double down on some of these sectors to improve and amplify the impact, but also to build the foundation for a more sustainable, more vibrant, more diversified economic growth story moving forward.
And on that point about diversification, I thought it was noteworthy that His Excellency, the Finance Minister, Mr. Jadaan, pointed out that 52% of the economy now comes from non-oil sources. To what extent do you think that provides the Saudi Arabian economy with a buffer to what's going on with oil prices? Because there has been quite a lot of downward pressure on the price of oil.
So that's the objective of Vision 2030, minimizing the impact of one commodity price on our ability to grow the economy. Traditionally, our government spend relied on oil revenues, our economy relied on government spend. Both of these relationships today are relying less on each other. So today, for the first time, we passed in 2023 the 50% mark for non-oil activities as a percentage of total real GDP. Today, that reached 52. We expect this to go higher and higher. It started at 47 before the vision. Even if it's a few percentage points, these represent a structural shift that takes decades sometimes to achieve. So while we're excited about this achievement, we don't see it as a milestone that we'll over-celebrate. It's a baseline. It's today's baseline, yesterday's achievement. We want to focus on how the growth can be of higher quality, representing more private sector dynamism, more opportunities for highly valued jobs for people in Saudi Arabia, and more non-oil exports.
That was the Saudi Minister of Economy and Planning speaking to Bloomberg's Jumana Pasechi, of course, the host of Horizons Middle East. Staying in the Middle East, Iran is going to be holding nuclear talks with European countries this week, including France and Germany. For more, let's bring in Bloomberg's Golnar Montevella, who spent many a year in Iran, 7 years, I believe. Talk to us about the talks that we expect to happen. How consequential could they be? What is the focus of these conversations between France, Germany, is it the UK as well, and Iran?
So what we've been told so far, that it's a meeting between the E3, that is France, Germany, the UK, and Iran, in Geneva tomorrow. And as far as we know, they're taking place on a deputy ministerial level for the moment. But these talks actually were first mooted back during the UN General Assembly in September, when Iran's President Masoud Pezeshkian went there very much with this view of trying to make contact with Western governments and countries, particularly parties to the Joint Comprehensive Plan of Action, which is, of course, the nuclear deal that they agreed in 2015 and that Donald Trump withdrew from in 2018. So he very much has a mandate to try and revive that deal. And he went to New York a couple of months ago, really with an intention to try and get some meetings planned. And he told us, actually, at the time exclusively that he was hoping to get some meetings on the schedule, on his schedule, and this is the outcome of those discussions in New York. But it's very early at the moment. We don't know exactly what they're going to talk about. We know obviously nuclear is in there, but the Iranians also say that it's not just about that. They want to talk about the region. They want to talk obviously about the security situation. As we know, Iran is very much engulfed in this conflict with Israel, and it's obviously very much involved in what's happening in both Gaza and in Lebanon, and with Hezbollah. So that all of those things, I think, are going to be on the agenda.
Yeah, which opens up a huge number of questions about what their motivations are then. Is this about an oil revenue story? Are they serious about maybe putting into a sandbox their nuclear program, at least for now? And do these talks matter at all if the US is not at the table?
I think they're very important in terms of the recent elections we've had, obviously, in the US. This massive change we're going to see flipping back to a Trump administration. He's going to come back. The Iranians don't know, none of us know, whether this next iteration of Trump is going to also feature the famous maximum pressure strategy that he imposed on Iran the first time around, that was so bad for the Iranian economy and caused so much kind of instability in the region, and specifically in the Persian Gulf. The Iranians, from what they've signaled so far, they don't want a repeat of that. They don't want to see maximum pressure, the sequel, if you like.
John Bolton's not.
He's not there. Michael Pompeo is not there. But that doesn't mean that the neoconservatives obviously don't have a voice. We had this very strong tweet from Michael Waltz the other day saying that Iran is the root cause of the Middle East's problems. We have to go after Iran. That doesn't bode well. At the same time, with Trump, you never really know what he's going to do, or exactly what he's thinking, or which advisors he's more inclined to listen to. So there's a lot up in the air for Iran. And it has to, I guess the sense is that it has to get its its ships in order. It has to kind of get everything lined up where it can in order to contain any further escalation with the US, because its economy really can't afford anything like that right now. And the Islamic Republic is not a particularly popular system at the moment. If you look at election turnouts, if you're using that as your barometer, they've been successive record low election turnouts for the last 3 major elections. So the regime itself isn't in a position to kind of...
Still some individual and rare but very brave protests as well.
Yeah, there are.
Golnar, thank you very much indeed. Always fantastic in terms of how we think about Iran, with the talks and focus then over the weekend between Germany, France, the UK and Iran to monitor. Bloomberg's Golnar Motivelli, thank you. Coming up ahead, we're going to get another view on the US consumer. Stay with us. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Welcome back to Bloomberg Markets. I'm Tom McKenzie in London. European equities are up 0.4%, a sharp 0.4%, snapping 2 days of losses. Some relief coming through for the tech sector when it comes to the question of US restrictions, planned US restrictions on sales into China, and that market, maybe those restrictions being a little softer, a little easier than some had expected. So you're seeing a relief in technology. It's one of your leading gainers across the sector right now in Europe. The US, of course, is closed for Thanksgiving. Happy Thanksgiving, everyone out there. Currently, European futures pointing to the gains of 0.2% when markets reopen. NASDAQ 100 futures looking to add 56 points. Let's flip the board and have a look at euro dollar. The single currency is currently under pressure, down 0.2%, trading at 105. 298 is what's been yielded on the French 10-year debt, the OAT. That's in focus for us because, of course, concerns about whether or not the French government will get its budget across the line. Brent is up in the session, up 0.6%. OPEC Plus has pushed back their meeting to December the 5th. And gold is also rallying in the session, up 0.3%, currently back above 2,644. Let's get to what's happening in terms of the consumer and the retail space. Of course, it is Thanksgiving. That means that Black Friday is upon us. Sharon Martis, Director of Consumer Research at Refinitiv, joins us for a deep dive on the health of the consumer and what kind of bargain hunting we might be seeing this holiday. Sharon, thanks for taking the time on a holiday for you and everyone around you, of course. What are you seeing in terms of consumer trends? What kind of indicators are you looking for from this Black Friday?
Well, good morning, Tom. It's good to be here. Yes, Black Friday marks the beginning of the holiday season, and at LSEC, we're looking at about a 2% growth for the season, which is actually not bad. It shows that there's consistent growth, especially given what we saw last year. We had a very strong holiday, and on top of that, we're expected to see a 2% growth this year. Now, in the United States, the American consumer has become very value conscious. This is because they're still dealing with high, sticky prices. And as a result, the retailers went ahead and started their promotions way earlier than the actual Black Friday. They started them all the way back in October in order to try to lure those shoppers in, which they have. Already, we're already seeing that a lot of the items are flying off the shelf. The sold out rates are much higher than they were a year ago. So this all is pointing to the fact that we might actually have a jolly holiday season for retailers this year.
Well, talk to us a little bit more detail about the price-conscious consumer in the US then, and how that's being reflected in different segments of the retail space. How do you expect that story to evolve?
Yeah, so in a collaboration with Centric Market Intelligence, LSEC discovered that actually this Black Friday, the average discount has come down from 39% last year to 34% this year. And that's actually the lowest average discount offered by retailers that we've seen since we started collecting this data about a decade ago. On top of that, the discount penetration, which is the amount of merchandise that retailers are offering to consumers have actually come down as well to one of the lowest levels that we've seen since 2016. So what this is telling us is very telling about the retailers, actually. They are being very strategic this year in the amount of merchandise they're offering way less merchandise. And on top of that, they're offering very measured reductions, and they're doing this in order to protect their margins. So as a result, it's going to be more of a battle between the consumer and the retailer. The consumer will only open up their wallets if they feel that they're getting a very good discount and promotion, whereas the retailer will be offering them strategically over periods of time, but not as steeply discounted as they usually were over the past 10 years.
Okay, so interesting the retailers are trying to ring fence those margins. I mean, to be expected, of course, but that tension between the consumer and whether or not the price point is going to be right when it comes to the retailer as well in terms of protecting those margins. What is going to be the kind of demographic changes that you're monitoring as well? We hear from some other analysts that the top end, the wealthier end of the consumer basket, that those consumers are relatively insulated. How is the breakdown that you're seeing being reflected across the different demographic changes?
Well, so the low-end consumer has been hit the hardest because of the sticky high prices that we've seen. And as a result, even the dollar stores have told us that we've seen it in their earnings report that their numbers have been hit the hardest because of this consumer holding back on spending. Now, when it comes to the middle and even upper class consumer, they still want designer clothing, but they want it for less. And that's why we see that the off-price retailers like Ross and TJ Maxx have been performing much better than the other retailers. Both middle class and upper class consumer will be engaged this holiday season, but they're still going to be looking up for those values. Even the high-end retailers will be offering some discounting, but it's not what we've seen compared to the previous years. Again, they're going to be very stingy with those discounts. This holiday season, gift cards are expected to be a big winner, beauty and luxury as well. But when it comes to beauty and luxury, those two sectors are still going to be the stingiest when it comes to the average discount offer to the consumer.
Oh, okay. Gift cards and luxury with maybe some of the other products in the mix there as well. What does it talk to us about the online versus offline experience for the consumer? Is there one part of that ecosystem that's going to get more of a boost in the next 48 hours or so? Is offline going to finally get a bit of a leg up?
So it's interesting because throughout the year, we've seen that the consumers have been gravitating towards the omni-channel experience. This is not just online on your computer, but it's also using mobile and ordering items and then picking them up at the store on their way to home after work. So the omni-channel experience is key to the U.S. consumer. They're all about instant gratification, and they want what they ordered right then and there. However, when it comes to Black Friday, it's a whole different experience. Yes, shoppers have been doing comparison shopping for weeks ahead of Black Friday, but it has become a tradition here in the United States. And every year when I go to the mall, I still see a big amount of crowd, and I do talk to them. And it's the tradition of families visiting each other and waking up early and still hitting the malls for those latest items, fashion items, and buying gifts for their friends and family. So when it comes to Black Friday itself, a lot of people will be showing up at the malls, despite the fact that for weeks ahead of Black Friday, they've been doing a lot of price comparison. Now, when it comes to after Black Friday, after the Black Friday weekend, on Monday, we're going to see a lot of people actually from the office shopping for Cyber Monday. And that's also tradition here in the United States. So Black Friday itself, a lot of people, a lot of traffic in the malls. But then going into Monday, we're going to see a lot of online traffic.
Yeah, okay. Well, we'll see if that has an impact on productivity then. Maybe we should watch that data as well after Monday. Just before we let you go then, in terms of the desire and the appetite then for experiences amongst the consumer, whether that's dining out or other experiences, how do you expect, how much demand is there for that part of the piece and the pie right now?
So that demand actually had slowed down for the most part in the beginning of this year. But our LSAG retail index shows that in the holiday season, the hotels, restaurant, and leisure sector is actually expected to be the second strongest in terms of earnings growth rate. They're expected to see a 4.5% pickup year over year compared to a year ago. And again, last year when shoppers went out, they were eating out and restaurants did very well. So the fact that we're seeing about a 5% growth this year shows that it's still important to consumers that while they're out with their families this holiday season, to have that experience, to go out and eat, to travel. So therefore, there will be a pickup and that demand will be, again, strong. In fact, the strongest we've seen in 2024.
Okay, Sharon Martis with the insight there, the lens on, of course, Black Friday, what we're seeing in terms of shopping trends from Refinitiv with the analysis. Thank you very much indeed, and a very happy Thanksgiving. Now, turning to tech and the rapid growth and importance, of course, of AI, Google's director of EMEA Android partnerships tells Bloomberg about what she handles and how she thinks about the challenges that come with artificial intelligence. Take a listen.
We've had 7 AI principles that we've been abiding by since 2018, right? This is before even the regulations in these areas came by. And those 7 principles are important to be ensuring that we're working on societally beneficial, using the technology for challenges that are societally beneficial, that they break the scientific, barriers and allow technology to solve the most difficult of problems, whether that's languages, whether that's healthcare, whether that's agriculture, right? Ensuring that things are privacy first, ensuring that we do away with biases in these systems, and so on and so forth. I think there's a 7 point, I can't remember them all the top of my head, but there's 7 points that every Google product and every innovation that we work on is underpinned by these 7 principles that we've developed since 2018. But we're obviously working with governmental organizations, private organizations, the industry, to ensure that we're all moving in tandem and we're all working in a way that is actually protecting our users and the populations that we work for. Ultimately, we only serve the people who are going to benefit from these technologies.
And finally, Miriam, you talked a lot about the different growth opportunities. What do you see as potentially the biggest opportunity in 2025 when it comes to the African continent and Android partnerships? Is it these data centers? Is it the cloud business? Is it investing in developers? I mean, where do you see the growth really coming from?
Jennifer, am I allowed to say all of the above? Where I see the opportunity coming from, Jennifer, is that, where I see the opportunity coming from is, at the end of the day, I said to you, we have almost 800 million people we must connect on this continent, right? And to benefit from the internet. And 800 million people means we have to be able to put the computing power or the supercomputing power in all of those hands. So there's growth there when it comes to smart devices that goes into the hands and homes of the users so they can get the best out of the internet. But also going with that, Jennifer, is ensuring that our developers have all the tools they need to continue building innovative solutions from Africa and for Africa and the world. The third thing where I see the growth coming is continuing to invest in innovative infrastructure that allow us to lower the access barrier, right? And then thirdly, or rather fourthly, I would say we need to keep up to date with the technologies that are rising, these exponential technologies, to be able to solve the challenges that are most relevant in our countries, right? In all of the markets that I work with. And for us, we believe AI is really going to be that transformative technology that's going to exponentially change the way we use technology to resolve the most relevant challenges on the continent and beyond.
Well, that was Google's director of EMEA Android partnerships, talking about the opportunities, the challenges around artificial intelligence. Some lines crossing right now. We're hearing from the Russian President, Vladimir Putin, in a conversation with the state-run news organization IFX. You can see live pictures right now, in fact, of the Russian president making these comments to IFX, saying on one hand that the Bank of Russia will decide on the inflation control measures. This after the ruble, of course, has come under pretty significant pressure in the last day or so. Also referencing that phone call he had with the German Chancellor Scholz, saying that dialogue is possible in the future too. Again, that is in reference to that phone call that he held with the German Chancellor Scholz. Putin saying that he and Scholz did not change their minds after the call, but saying that possible to have dialogue in the future. Just wrapping some of those lines coming through from the Russian president. We'll keep across, of course, that for you as he, of course, continues to take questions, largely, you would have assumed, from his own domestic media. Coming up, the UK regulator revising its plan to name and shame companies under investigation. We'll bring you the details. Stay with us. This is Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Welcome to Bloomberg Markets. I'm Tom McKenzie. European equities are gaining 0.4%, snapping 2 days of losses. US futures also in positive territory, pointing to gains of 0.2% when the US returns from the Thanksgiving holiday on Friday. Nasdaq futures pointing to gains of 64 points. Now, uncertainty is clouding the outlook for many investors, of course, with a second Trump term likely to bring big changes, to say the least. That's an understatement. Wells Fargo Vice Chairman Doug Braunstein caught up with Bloomberg TV earlier this week saying debt markets are wide open heading in to the new year.
A number of the factors, quite frankly, that I think are going to drive M&A activity both today and going forward into 2025. And it really amounts to the factors that create confidence for CEOs. And there's really four key ones here. The first is the underlying economic environment. It feels increasingly comfortable to folks that we've had a soft landing. There's an expectation that we will have a positive GDP for 2025 and going forward. The second is the robust support in the capital markets. The debt markets, which we can talk about in a little bit more detail, are wide open. We've actually had a number of those capital markets with record issuance in 2024, and credit spreads are at or near, for many of these categories, multi-year tights. The third piece is the stock market. You've got sellers in the public markets where their stock prices actually performed really well. And in particular, the small and mid-cap names in the Russell, Romaine, that you talked about, those comprise a lot of sellers in the market. And when you're selling at or near your 52-week high, it's a much easier discussion in the boardroom. And then finally, the buyers, with that, their own stock prices at strong performance and this access to capital, that makes for a very potent M&A combination.
Yeah, that's quite the cocktail. So I mentioned that you joined Wells Fargo in February with this mandate to focus on expanding the investment bank operations. There's a lot of excitement about M&A and IPOs picking up. How does this influence your plans when it comes to hiring for this build out of the investment bank?
Yeah, so Scarlett, actually, you also mentioned, in the last 2 weeks, Wells has announced two $10 billion plus transactions, one advising on the sell side, which was Berry, one advising on the buy side, Quick Creek today. Those are, I think, representative of some of the investments that Wells has already made. So over the course of the last 24 months, we've already hired over 60 managing directors across our M&A business, our equity and debt capital markets, and our coverage businesses. And as you know, when bankers join, it takes them time to understand the systems of our big institution and to re-cement those relationships with their clients.
And that was Wells Fargo Vice Chairman Doug Braunstein speaking with Bloomberg's Romaine Bostick and Scarlett Fu. Turning now to the UK, where the Financial Conduct Authority is revising its plan to publicly announce companies under investigation after sparking backlash, now giving firms 10 days to object before probes are made public. Bloomberg's Jonathan Browning joins us for the details. I've been reporting this out with the team. Jonathan, what do we know? This was called the name and shame proposal from the FCA, and they've moderated it under pressure from lobbyists in the city. What have they come to in terms of the decision?
Yes, it was called the name and shame, although to be clear, the FCA never called it that. It acquired this sort of moniker, and it became a sort of a pretty easy then shorthand in the city by a lot of lobbyists for kind of pushing back against the FCA, for pushing back against this attempt to be more transparent about enforcement investigations. Today, the FCA has kind of acknowledged that there was a huge pushback and have tweaked the proposals to make it clear, as you say, that there is a chance and an opportunity to discuss internally before they go public. However, the FCA is still really clear that they want to move forward on this. They're really clear that boosting the transparency around their enforcement process is actually good for the city. It is a deterrent, and it encourages whistleblowers, it encourages people to come forward. And so they're saying, yes, we're going to kind of tweak it around the edges, but we are still intending to name some firms, and it's only firms, earlier in an enforcement process.
10 days doesn't sound like very much of a reprieve for companies that are under investigation, being probed, being looked at. Is that enough time for them to put forward their case?
I mean, the FCA says it is enough. The initial kind of commentary around this has been sort of mildly positive. There may be a bit more kind of pushing and shoving from the lobbyist side around this. The FCA themselves are saying this is still a consultation, nothing has been decided. I think the FCA feels that in an investigation, these companies will already be backwards and forwards with the FCA, so then another 10 days to discuss around publicity shouldn't be too onerous.
Okay. Do other jurisdictions have systems like this in place? And what's the politics of this, John?
So the other, there is nothing quite like this in other countries, and the SEC, which is sort of perhaps a sort of sister regulator, if you want, to the FCA appearance. Politically, it became something of a football when it was first announced. It was first announced kind of in the spring and seized on by the Conservative Party. Jeremy Hunt made a pretty rare intervention when he was Chancellor to kind of say that perhaps this ought to be looked at again, which is unusual. And I think the FCA has sort of recognized that noise like this is not a good thing. Today, the enforcement chief, Therese Chambers, herself said maybe this didn't land as well as we should have laid it first time round, that it should have been something that was a bit more kind of carefully introduced.
Yeah, there was that interesting kind of mea culpa in the note to some of the people that they've been consulting with on that front from her. Where do we stand in terms of what this does to the competitiveness of the City of London and the implications for investors?
So the competitiveness piece is part of the consultation, like it's very clearly in the wording. The FCA themselves has actually been quite forceful on that and said it is in the interests of the city as to be competitive that we are seen to enforce with a transparent approach. That actually that is competitive, a competitive plus for London, for the city. And yeah, I mean, I think it was quite interesting that they were prepared to address it, but also kind of move quite forcefully that it actually can be a good thing for the city's competitiveness.
Jonathan, thank you very much indeed. One of the authors of the piece around regulators here in the UK adjusting, moderating their quote-unquote name and shame, not officially, of course, that's not how they title it, name and shame plans, after some pushback from some powerful voices within the city, trying to strike that balance. Bloomberg's Jonathan Browning with the reporting and the details. Thank you very much indeed. European markets, European stocks are up 0.4% so far this Thursday. Here in the UK, the FTSE 100 is just eking out gains as well of 8 points, trading at 8,283. It's a slightly brighter picture, interestingly, over in France. The CAC 40 is up 0.5%. We've heard from some ministers in France suggesting that they could be open to moderating that budget proposal that has caused such consternation with pressure, of course, across French debt. Talking of which, you can see the French 10-year yielding you 2.98. Euro dollar under pressure, down 0.3% now. That continues the sell-off in the euro versus the US dollar in the session today at 105, $73 a barrel on Brent, up 0.6%, and gold is up 4 cents, rallying as well, the yellow metal. Coming up, Ben Laidler of Bradesco BBI and Tina Fordham of Fordham Global Foresight with that view on geopolitics, and Ben Laidler, of course, on the market. Stay with us. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in now a GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason I love thinking about black swans, and at the office everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
In case you missed it, on Bloomberg Technology.
We're excited to really change the expectations for space companies where you have this always-on, reliable, and frankly dynamic satellite connectivity that you would expect of your power grid or of your cell phones. And so we think that this is a huge opportunity space, and our first contribution to it is through shared infrastructure.
You can see this whole ecosystem developing, and you have an exponential growth right now because easier access to space means more demand for space, and that's the definition of an exponential growth function. So if you think about someone like Varda, who is only possible now because access to space is cheaper and easier, we're demanding more access to space.
I think that's what's so exciting from a business perspective, the fact that if you can do it, you're one of a few numbers of organizations in the history who've actually pulled it off. And so it creates a very defensible position, because again, space is very, very hard.
Don't miss Bloomberg Technology live every weekday.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome to Bloomberg Markets. I'm Lizzie Burden in London. Happy Thanksgiving. Thanks for joining us. Let's get a check on these markets. You're looking at the Stock 600, currently higher 0.4%. A close eye on the CAC 40 in Paris, of course, higher 0.5% actually, despite the political turmoil. Of course, US markets are closed today, and it's thin volumes elsewhere. But as we look at the futures picture, S&P E-minis and Nasdaq futures both pointing higher. We had that equity rally falling off slightly yesterday, knocked by the tech sell-off and core PCE climbing, but we'll get into that. And if we flip over to the cross-asset picture, euro-dollar is actually at a 105 handle, so weaker 0.3%. Again, as we digest that political turmoil, lots of speculation about euro-dollar parity. Looking at the 10-year oats yield, currently 2.9 is where we trade, weaker 5 basis points, but we did cross that important psychological threshold earlier, the benchmark yield matching Greece's for the first time ever, but we're lower than that now given the concessions made by the French finance minister, and that's another thing that we're going to dig in later in the programme. Brent, though, at $73 a barrel, the OPEC Plus meeting delayed now until December the 5th. What does that mean? Does it mean that they haven't managed yet to hammer out a deal? Another thing we shall discuss. And Brent trading at $2,646 an ounce with all of this geopolitical risk in the background, but of course the ceasefire in the Middle East in place at the moment. So Thanksgiving usually kicks off a Santa rally, but the US equity rally took a breather, as I say, yesterday. So how much room is there left for stocks to run before the end of the year? Let's discuss now with Ben Laidler, Bradesco BBI Head of Equity Strategy, who joins me now. Hi, Ben. What about the S&P 500's health into the end of the year? We had JP Morgan equity strategy team yesterday turning positive, a rare thing in the past couple of years. Do you join them?
I think we continue to be positive, both, I think, for technical reasons, but also for the fundamentals. I mean, we're looking at this, we're getting another dose of US economic and stock market exceptionalism with the outlook for Trump sort of 2.0. I think that gives you upside to the economy and upside to earnings. You mentioned the technicals, seasonality. Yeah, I think there's a lot of people have been left behind by this rally so far this year. I would fully expect to see a little bit of performance chasing into, the end of the year. And history's on your side. You make 40% of your annual return typically in the last sort of 3 months of the year. And as you say, Thanksgiving is typically the start of the Santa rally.
But then when that seasonality effect drops off, do you start to see weakness in Q1?
I think the fundamentals here are very solid. I think this is going to be US-led. We have double-digit earnings growth for next year. We have a broadening earnings story. We've still got tech delivering 20% odd earnings growth, but we're going to start seeing a greater contribution from some of these rate sensitives that are beginning to benefit from the rate cuts the Fed's done. We're going to see some of this commodities weakness, which is, we've seen a lot of this year, maybe begin to drop out of the numbers. And this is even without any acceleration, potentially, from Trump 2.0 and potentially corporate tax cuts. So I think that is, upside relative to a base case today, which is already, now cast for this quarter, it's nearly 3% GDP growth and 10% earnings growth. I mean, that's your base case, and I definitely see upside risk to that.
Okay, so that's interesting. How are you thinking about Trump policy as we hear more about his appointments, and he has all of these posts on Truth Social? Of course, we've had Scott Bessent appointed as US Treasury Secretary, some seeing him as a potential counterweight to Trump policy, others expecting him to be this loyal foot soldier. Where do you stand?
So I would make a distinction between, US assets, which are embracing Trump 2.0 on the basis of stronger growth and lower corporate taxes. And this has real ramifications for the rest of the world. Let's not forget how supersized the US is. It's the biggest economy in the world, obviously, but it's 65% of global equities. So it's just dragging the rest of the world with it on the equity side. But on the rest of the world, it's a less positive story. I call it, we've sort of pulled defeat from the jaws of victory. We were expecting lower bond yields, lower interest rates, a weaker dollar to juice returns in the rest of the world. I would say that's delayed here, probably not derailed, but that rest of the world equity story is probably more one for later in 2025. Right now it still remains all about this sort of extension of US exceptionalism.
But are there any winners to come out of all of this? I think perhaps of Japan today benefiting out of, the expectation that it will benefit as China suffers in the Trump tariff war.
I think there's going to be a lot of sort of silver linings here and a lot of winners which maybe we're not considering. So Mexico, for example, is considered to be in the crosshairs of a lot of these Trump policy issues. I think it ultimately ends up, being a winner. If you're going to crack down on trade with China, someone like Mexico, the nearshoring story probably just accelerates once you look through all the noise. But even China, if we crack down on trade with China, do we just force the Chinese to do more fiscal stimulus, which we haven't seen very much of yet? So I think we're in a new normal of sort of heightened volatility, which we're just going to have to live with. But I think when all is said and done, there's going to be a lot of unexpected winners here and a lot of silver linings.
Well, I mean, you mentioned the Chinese stimulus. On that domestic picture, how confident are you that that stimulus will materialize, that it'll actually be significant?
Not very. I do think it's coming, but we've had a number of sort of false dawns. I mean, I think our base case is 3 to 4 trillion of stimulus coming out in the first half of next year, of which you've barely seen any yet. And I take some comfort from the fact that just expectations are very low. And all you need to do is really take out a little bit of an insurance that growth is not going to slow much more. You have a lot of trapped liquidity in China. It's already a very cheap market. And interestingly, very uncorrelated with the rest of the world. So I think it's interesting, but obviously we've had a lot of false dawns there before.
And just going back to the winners and losers here, I mean, when you think about UK equities, we're kind of in the middle of the US and Europe, and we've got this new Labour government. How are you thinking about the UK? Is it an opportunity to get it while it's cheap?
Well, I'd say the UK's been a value trap until now. It's been cheap for a long time, but without any sort of upside catalysts. It lacks a real trigger. But most UK companies do most of their business in the rest of the world. The US is a major export market. As I said at the beginning, if US stocks are rising, if the US economy is humming along at 3%, there's a number of UK companies that will really benefit from that.
Which sectors are you looking at?
I mean, commodities is one, which maybe it's sort of an each way bet if we get a bit of China's stimulus, but we also get more US demand. Healthcare, pharmaceuticals, another big one. Valuations across these sectors, very, very cheap. So, a little bit of, and the UK has got very small. So, a little bit of good news, or maybe less bad news might be the better way to put it, can go a very long way in some of these depressed, cheap assets, like European equities, like UK equities. You don't need good news, you just need less bad news. And I think you give it a few months, let's get Trump in office. I think you may very well see that.
Yeah, we definitely need to see how it plays out. We've got an interesting story about this on the terminal today about how actually, Americans are big buyers of British exports, the likes of Land Rovers, machinery, chemicals, pharma. Do we actually see a hit, even if we dominate in services here in the UK? But lovely to talk to you, Ben Laidler. Thanks for making time for us this Thanksgiving. That's Ben Laidler, Bradesco, BBI's head of equity strategy. Good to see you. Well, coming up on the programme, we'll get back to the French story. French assets very much under pressure as a possible no-confidence vote threatens to oust the country's prime minister. We'll be getting more on that next as we look at the CAC 40, currently actually stronger, 0.6%. Stay with us. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Season is here.
This earnings season tells us there is more to life than mega caps.
Bloomberg is first to break the numbers.
Let's talk about Deutsche Bank here.
BASF with that big exposure.
We have numbers from Barclays, from Hermes, Anglo-American.
We've got a lot of earnings to work our way through.
With the smartest insights.
I think the BBVA has posted really a very strong set of results today with that bottom line.
Some more cautious on Q3, but I think it's in a better place than it was.
Continuing coverage on Bloomberg.
Welcome back to Bloomberg Markets. I'm Lizzie Burden in London. It is 2:12 here in London. Happy Thanksgiving if you're just joining us. Happy holiday. But let's go to France now, where French assets are under pressure as the country faces a deepening political crisis. A possible no-confidence vote threatens to oust the Prime Minister, Michel Barnier, causing uncertainty and fueling investor concerns. You're looking at the CAC 40 actually higher 0.8%, and the 10-year oats yields are currently weaker, 7 basis points at 2.95%, but we did actually see them crossing that important psychological threshold, matching Greece's for the first time ever higher than 3% earlier in the day. Weaker than that now, but the concerns in the market do continue. Euro dollar at a 105 handle, weaker 0.3%. But we can get more analysis now on the political situation with Bloomberg's Alan Katz. Alan, great to have you with me. We're looking at actually a concession made today, and I think that's perhaps why we've seen a bit of a paring back of the yield on 10-year oats. How significant is this that has been offered by the French finance minister politically, and hence this narrowing of the spread between oats and buns?
So it's potentially quite significant. I mean, it's hard to tell quite yet. We don't have really enough in the way of details to understand exactly how far the government is willing to go. But basically, one of the fundamental issues between Michel Barnier's government and the budget it proposed and Marine Le Pen's far-right National Rally has been things that she says are going to really hit middle-class French savers. And her goal is, she says, is to really protect them. And so what you have is Michel Barnier, just a few minutes ago, in an interview to the Figaro newspaper, said that the French government was not going to raise taxes on electricity. It's a little bit complicated, the formulation, but what it fundamentally means is that electricity prices will probably go down more than they would have otherwise gone down for most French people. They were going to go down anyway, even with the tax increase, but now they should go down even more. It is one of the RN's key demands, and so it really could be, I guess it's the first moment that we have that shows the French government moving, and so that would potentially allow the RN to say, like, actually, we've gotten something tangible and significant for the people who voted for us or the people who support us, and therefore we're willing to abstain on whatever no confidence vote might come down the road, and sort of everyone goes home happy. If this is going to be enough to get them to say that, I actually have my doubts, but it's hard to tell you. The RN is meeting at the moment to discuss sort of their plans going forward for the next week. There's going to be several sort of moments of tension next week where they could potentially vote to try to oust Barnier's government, and so they're trying to decide right now how they're going to respond to it, and we have the government moving at the same time. So there's still a lot of moving pieces, but there does appear to have been some sort of effort to find an off-ramp, and as you point out, that's had there was already some discussion of that this morning, and that it already had an effect on French bond yields, pushing them lower and narrowing that spread with Germany a bit earlier today, and that appears to be continuing.
I mean, you mentioned Marine Le Pen, the leader of the party, so let's take a listen to what she's been saying.
If the budget stays the same, yes, this is not a surprise. We always said it for the past 3 months. I'm telling you, if this budget is not approved, the budget of last year will apply, and actually it's not as bad as this one, as there are less taxes for the working and middle classes.
To the National Rally leader, Marine Le Pen there. Alan, what do you think it's actually going to take to get her to play ball?
Well, first of all, I'd say she's being pretty optimistic, saying that actually things would be better if there were no budget. I think that's, I mean, she's partly correct in that there are systems in place in France for government to continue functioning. What that means in terms of really net, is it better or worse for people? It's very likely to be worse. But that said, she does have a whole series of demands. Among them is not raising taxes on electricity. Another one is there was a plan to delay some increase in retirement payments to retirees, sort of doing part of an increase on January 1st, part in July, rather than doing all of it on January 1st. One of her demands is to have that all done on January 1st. It's essentially a series of measures that would put more money in the pockets of largely sort of blue-collar and middle-class workers. Michel Barnier appears to be moving on at least one of them. Is that enough, again, to make her be willing to say publicly, I will abstain on any no confidence vote, which, just so that viewers understand, the left is going to vote to oust Barnier no matter what happens. And so the deciding vote ends up coming down to Marine Le Pen. So she is the kingmaker. She basically, if she says, yes, I'm going to join a no confidence motion, he's out. If she says, no, I will not join, or my party will not join a no confidence motion, he remains. That's sort of the way it's worked out. So that gives her a lot of control, and it appears that she is getting somewhere. Again, is that enough to get her to fully back off? It's hard to say yet. I mean, if I were her, I would probably say, like, oh, well, I won't vote because there'll be several no confidence motions. I certainly won't vote on the first one or the second one, but you still need to give me more before I vote on the last one. Is that what she's actually going to do? I don't know yet.
And Alan, where we've seen French 10-year borrowing costs matching Greece's for the first time ever, I wonder how important that is. Is it a red herring, or is it actually an important marker?
I would say both in some ways. So there is a good amount of tension in the French bond market, in particular, the French stock market as well, which has really underperformed other European and certainly U.S. stock markets since the beginning of the year, and particularly since June, when French President Emmanuel Macron dissolved Parliament and called the snap election that got us into the situation that we are in today. But the French bond yields, the reason it's the same, that the yield is roughly the same as Greece, is less that there is tension in the French bond market, but there's in fact been a big drop in Greek bond yields, because Greece has actually done a very good job on its deficit, on its debt, and it's become really the darling of bond investors, whereas France has become less the darling, and therefore there's been some tension on it. But French bond yields throughout the month of November have actually been going down, but they've been going down much less quickly than Greece has. And so it's not, in some ways it is a red herring. It's not that France has suddenly become what Greece was a decade ago. That's not the case. But it does show that whereas France had a really privileged position as being viewed as roughly like Germany, it's not quite viewed like that anymore. And some other countries are becoming much more viewed as very safe havens that, bond investors outside of Europe can really safely put their money and not think about it. And Greece has, oddly enough, become one of those countries.
Okay, Bloomberg's Alan Katz in Paris. We thank you for that crucial context. Actually seeing the French banks back in the green now, BNP Paribas, SocGen, Crédit Agricole, all in positive territory despite all of this political turmoil. But, of course, the longer-term picture, that underperformance of the CAC 40 relative to the Stoxx 600. Still ahead, though, on Bloomberg Markets, how Nouriel Roubini is preparing for the next Trump administration's impact on the global economy, as we have markets closed stateside, but futures pointing higher for the opening session. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Now, investors remain uncertain on the impact of President-elect Trump's tariff threats, with many concerned that they could have adverse effects on the global economy. The famed economist Nouriel Roubini has warned that the policies may lead to higher inflation and lower growth.
Some of the economic policies of Trump may lead to higher economic growth, being pro-business, keeping tax rates low, deregulating the economy. But unfortunately, many of the other policies are going to have an implication of higher inflation and lower economic growth. The first thing he has already announced is going to be tariff against Mexico, Canada, and China. And that's only the beginning. He has said we might have up to 20% tariff on all our trade partners, up to 60% against China. He wants to have massive deportation of people. In the last few years, the increase in migration has kept the lead on wage growth, has increased the labor supply, has increased economic growth. So definitely mass deportation is stagflationary. He wants not only to make all those tax cuts permanent, but he made other promises. No taxes on tips, on overtime, on Social Security, on income earned abroad, and so on and so on. It's estimated these things may add to the deficit by $8 trillion. Too much demand, inflationary. He might want to weaken the dollar. That's going to be inflationary. He may interfere with the independence of the Fed. Getting out of the Paris Accords is going to make climate change much worse, increase food prices and things of that sort.
It's interesting, Nouriel, a lot of things you just said are what a Bitcoiner would say as to why you should buy Bitcoin. There's now the Bitcoin ETFs. They're over $100 billion, clearly a big hit. There's talk that it could be a strategic reserve. You have gold in the portfolio. Is there anything that could move you to add Bitcoin to your ETF to help accomplish some of these goals?
You know, the Bitcoin is highly volatile. It can go up by 10% one day and down 10, 15% another day. If you want to have a stable store of value, you would not put Bitcoin into your portfolio. The kind of assets we're actually thinking about are all assets that do well when you have lower growth and you have higher inflation, whether it's tips, short-term treasuries. Gold is a hedge against inflation, debasement, de-dollarization, geopolitics, financial crisis, some exposure to ag commodities that are going to do well in a world of inflation and of climate change, and environmentally sustainable REITs. So it's a diversified portfolio of assets that historically have done well in these types of tail risks. I'm skeptical for a lot of reasons about cryptocurrencies and Bitcoin because they're not currencies. They're not a unit of account. They're not a scalable means of payment. They're not a stable store of value. And if you want wealth preservation rather than high volatility, you want to stay away from those types of assets.
CEO right after a vacation than I am before vacation.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
Welcome to Bloomberg Markets. I'm Lizzie Burden in London. Let's get a check on these markets. It is, of course, Thanksgiving. Happy holidays if you're celebrating, but it means that US markets are closed and it's thin volumes around the world. Here in Europe, though, the Stock 600 is higher 0.6%. Everywhere in the green, including Paris, actually. The CAC 40 higher 0.9%. And if you break it down by sector across the continent, you've got about 3/4 in positive territory. Tech still leading the gains, higher 1.3%. But bottom of the basket are chemicals, lower 0.2%. Looking towards the Wall Street Open, we do have S&P E-minis and Nasdaq futures pointing higher. The equity rally kind of falling off yesterday in time for the holiday, knocked by the tech sell-off and that core PCE reading supporting the Fed's gradual approach. But if we flip over to the cross-asset picture, taking a look at euro-dollar, it's weaker 0.25% at 1.05 currently as this speculation about euro-dollar parity mounts. The turmoil in France on top of the turmoil in Germany. You're looking at the 10-year yield on oats, currently weaker 7 basis points at 2.95%, having matched Greece's yield for the first time ever earlier today, but lower now given the concessions from the French finance minister to the national rally. Brent is trading at $73 a barrel. The OPEC Plus meeting on Sunday now delayed to December the 5th, and gold trading at $2,646 an ounce, actually stronger 0.4%. So that's the broad view in markets as things stand. But despite the positive picture today, as I say, it's thin volumes, and the bigger picture is uncertainty, particularly around what's going to become of President-elect Donald Trump's tariff threats being made thick and fast on Truth Social. Many investors growing in concern about the adverse effects they could have on the global economy. We just heard that from Nouriel Roubini, but let's get more now from Tina Fordham. Fordham, Global Foresight founder and, of course, geopolitical strategist. Always good to talk to you, Tina. I wonder, you've seen markets kind of encouraged by Donald Trump's relatively benign, shall we say, picks, example, Treasury Secretary, other key economic roles. Do you think that they're being lulled into a false sense of security?
Well, I mean, I think markets have focused on the aspects of the emerging Trump agenda that suit them the best, and there have been some competent and well-received picks, Treasury Secretary in particular, and others, the more questionable ones, not getting much attention. And, you know, there's some logic there, but U.S. markets are focused most on the Treasury Secretary. Global investors, though, are taking a wider view about the picks.
And in terms of tariffs, especially on Europe, Trump's saying that Europe's almost as bad as China. Is that just saber-rattling?
It's something that he said in the past. He certainly isn't, you know, his view of trade is fairly functional. He sees how many cars Germany exports to America. He's less relationship focused. Everyone knows that his style is highly transactional, but I think what really rattles the business leaders in the countries where we're advising people is the extent to which these tariffs will fall on allies and the sense of unpredictability about what the trade might be, because you know, commitment to defense spending or other non-economic factors like fentanyl and migrants over the border are factoring into the tariff strategy, and it's got people confused about how to prepare and what will come next.
Yeah, of course, we've seen quite different responses from Canada and Mexico to the post on Truth Social about these potential tariffs. But I wonder in Europe, is the leadership strong enough to respond to Trump? We're talking, of course, about the political crisis in France, Germany as well. Is that leadership going to be there?
I think that this is one of the most underestimated political risks that is emerging from the forthcoming second Trump administration. In Europe, we do have more multi-party coalitions. These are, more prone to collapse under pressure. In the immediate days after the U.S. elections, both Germany and Ireland announced new elections. In Germany, really, the German elections in February are going to be front and center. I'm calling it the biggest political signpost for Europe in 2025, German elections. And then we've seen turmoil in France as well. How does this relate to Trump? I mean, a crisis accelerates an existing trend, right? So it can't be blamed on the administration, but the combination, the double whammy, as we see it, of the potential for tariffs coming against allies, plus demands for increased defense spending in an environment where the 2% NATO target may not be enough to repel Putin from not only Ukraine, but maybe making inroads elsewhere, is going to put European governments under a great deal of fiscal pressure at a time when growth is pretty tight as well.
Yeah, I mean, we've seen today Putin saying that Russia could strike Kyiv with a new ballistic missile. You mentioned defense spending, but how soon do you think that Donald Trump is going to force the Ukrainian President Volodymyr Zelensky to the negotiating table when he comes to office?
Well, this is where the guesswork comes in, because Trump has said he would end the war in Ukraine on day one, but he hasn't said how he will do that. I think we should allow for more than one day for that to happen. But what you see is in anticipation of Trump's likely pressure, that there is already a Trump effect. Now, the decision by the incoming administration to appoint a retired general to the position of Ukraine envoy is already prompting a lot of guesswork, because we've been told that in the past he wanted to see U.S. aid be conditional, aid to Ukraine be conditional upon entering into talks. Putin has said that he's happy to enter talks as long as he gets to keep everything that he took, and that Ukraine doesn't have security guarantees. So, those are not very strong terms for Ukraine to enter into a negotiation with Russia.
Yeah, Putin will talk as long as it's all on his terms. Tina Fordham, Global Foresight founder and geopolitical strategist. Great to talk to you there. We're always good to have you with us. As we continue to monitor these threats from Putin, he warns of potential strikes on decision-making centres in Kyiv with these new ballistic missiles in response to Ukraine's attacks using Western missiles. So we'll keep across that for you. But coming up on the programme, on a lighter note, of course, it is Thanksgiving, and this year is a wicked season at Bloomingdale's. It's going all out on a new immersive strategy to attract customers. We'll bring you more on that next. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. it's what we own and build. So it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Keely Lyons deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Welcome back. Happy holidays. It is Thanksgiving, of course, and Bloomingdale's is going full Wicked, the musical, that is. Bloomberg's Scarlett Fu and Romaine Bostick have been speaking to Bloomingdale's CEO, Olivier Braun, about the reason behind this decision and where Bloomingdale's stands ahead of the holiday season in the US.
The US market is actually the biggest and the most intense market for department stores, so it's very, very exciting for us. As a specialist of department stores, I'm so thrilled to be here. But I think we can do things a little bit differently in the future. You know, I think reinforcing the experience, reinforcing for brands and for customers, I think there's room for improvement for the future. This is what we're working on at Bloomingdale's, is a new strategy.
And of course, you were in Europe and Asia as well, a lot of experience overseas. What have you noticed that's different or perhaps unique about the U.S. consumer and the way they shop and buy versus those in Europe and Asia?
Yeah, I think, you know, first, they're used to go to department store. The share of department store, the importance of department store for the customer is still very, very, very strong. When you compare with Asia, when you compare to Europe, the penetration here is very strong. But I think, you know, that the relationship with the department store and with retail overall is very transactional. And I think we have to bring back more about the storytelling from, you know, our brand partners to the customer. This is all we're working on right now. And this is a perfect illustration of what we're talking about.
Talk about how you do that. You use the word storytelling, and you hear that a lot, particularly in the fashion industry, right. The idea that, you know, you need to give people a reason to spend however much money on that handbag or shoes or whatever, telling a story. So how do you do that in a concept and more importantly, in a day and age where people are much more transactional? They just want to buy what they want to buy and leave the store or buy it online and pick it up and go home.
Mm-hmm. You know, when you're buying a bag, you're not just buying a bag, and especially for luxury brands or for premium brands, you're buying a story. You're buying a social marker. You're buying something special that actually is more than just a product. And we have to make sure that actually through the service, through the store experience, we're bringing that to the customer. The second pillar for us is exactly about that. It's about, you know, events, about activations in the stores. It's actually, you're not only coming to the store to buy. You're coming to the store because you're going to meet people you like, because you're going to see something different. You're going to live an exciting experience. So this is exactly what we're working on right now. And we want to make it bigger and bigger to reinforce the attractiveness of Bloomingdale's.
How transferable is that to other locations? I mean, this is your flagship location, so of course you go all out for it. But when you go to a store in Texas or California or somewhere else, can you replicate this?
Yeah, that's a very good question, Ramin. And, you know, because I think it's all about, you know, being Bloomingdale's and being a chain is actually, it's not only about the flagship. It's actually, we want to be, as Bloomingdale's, the local leader, the local destination. So we have to cascade that to every single store, to every single customer, and the teams are working on it. Of course, it's a little bit different. It has to be relevant locally, but we're doing that in every store.
Given your background in Europe and in Asia, are there plans for any sort of international expansion for Bloomingdale's?
I don't think so. We already have a partner in the Middle East who is performing really well. So Bloomingdale's in Middle East is actually a strong platform, but for now it's not a priority because we think that actually we have like a lot of opportunities in our domestic market, and we think that we can have actually strong growth in the future in the US, in our domestic market. Building a new platform in a new region is actually very, very challenging. I had a chance to experience that in the past, and honestly, starting from scratch, when you already have like mature models and mature department store brand in these regions is actually very challenging.
What about the mix between your amount of sales that you're getting from your brick and mortar locations and the amount of sales that you're getting from digital online sales?
So right now we're pretty much in line with actually our peers and competitors right now. So I think the market is around 30%, a third of the sales. But actually what we observe for the last few years is actually this fantastic growth of online. Well, not jeopardizing the store sales right now.
Is that like a different customer or is it the same customer?
No, actually we're seeing, so first online now is our #1 recruiting channel for new customers, but we have this ability to actually transfer our online customers to offline because you have the returns, because you want to actually book or see what you're going to buy on offline online. So that's a great continuous experience. I think right now customers are totally channel agnostic. They don't care whether they're shopping online or offline. They want to see a product, they want to experience Bloomingdale's, whatever the platform. So for now, we're talking about online, offline. Tomorrow, it's going to be social shopping. It's going to be, whatever the channel. I think it's really about relating and engaging with the brand.
If you take a step back, and I'm sure in contrast to what you see in Europe and Asia, the department store model has been struggling in the U.S. for a number of years now. What do you think is behind that? Why is the department store model not doing as well in the U.S. as it could be, say, in Asia or Europe?
Yeah, I think, first, the models in Asia and Europe right now are really flagship focused. So I think that's one big difference. And honestly, I think the flagships will have a bright future in the next 10, 20 years. It's not, I think, a problem at all. I think the problem here is managing such a large footprint. And that can be a challenge sometimes. At Bloomingdale's, we have the chance to be in prime locations and prime malls, so very strong locations. We have a limited footprint. So I think we have more opportunities than threats for Bloomingdale's in the future. I really do think that actually the department store model has a bright future, but it has to reinvent itself from the perspective of the customer, but also from our brand partners. We have to be relevant for our brand partners and rethink the model from this point of view.
How about the broader retail landscape overall? Are there too many stores in the U.S. overall?
When you look at just the pure market data, when you look at the overall market is actually slightly growing, the penetration of online is going up. So for sure, the average productivity of the square feet overall in the US is actually slightly decreasing. So yes, there will be probably some losers. It's why you have to challenge yourself and reinvent your model to remain relevant for your customers, but also for your partners.
I have to ask you, when you look at other retailers, and it doesn't necessarily have to be a direct competitor, who do you envy most? Like when you walk into their stores or you shop on their website, who do you just say, wow, they really got it right. I want to try to emulate some of this.
No, first, I really think that actually Bloomingdale's is doing that right. When I discovered the model, I'm sorry to say, but I'd say, no, but it's not the only, it won't be my only answer. But actually, honestly, I was very surprised by the level of engagement of the customer. The relationship that we're building with the customer and with our partners is actually good. And I think we can even do better in the future. But I think there's a lot of source of inspirations from our competitors, but also from other models right now, whether it's in terms of service, in terms of brand mix, in terms of events and activations. There are a lot of inspirations that are in retail and beyond retail. I don't want to give you any names, but I have a lot of source of inspiration actually in the US, but also abroad, which is another thing. I think we should not be too domestic focused because we're going to miss probably some good trends that are happening somewhere in the world.
And you think that maybe what we see abroad in terms of their approach to department stores and just retail overall, you think that's going to be palatable to a U.S. audience?
I'm absolutely convinced about that. I think, we have to bring the best of both worlds, and I think this is where we're going to perform and bring something different for the customer. The customer is ready right now for something different, more inspiring, and this, we can get it from some of the countries or some of the other models in the world.
So that was the Bloomingdale's CEO, Olivier Brun, hoping to defy gravity when it comes to that wicked collaboration. He was speaking to Bloomberg's Scarlett Fu and Romain Bostic. Coming up on the programme, we're going to take a look at oil prices as OPEC Plus delays yet another meeting. We'll have the latest on global crude markets for you next. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power. This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Welcome back to Bloomberg Markets. It's 2:51 here in London, and we're looking at Brent trading higher 0.4% at $73 a barrel. This is as OPEC Plus is delaying its meeting to December the 5th. It was meant to be online on Sunday, but Bloomberg revealed the delay, and the group's set to discuss whether to increase supply or prolong the curbs on crude production. So to discuss why they've done this delay, we can speak to Al Nightingale, Bloomberg News' team leader for oil trading here in Europe. Al, this has happened before. What do you read into the delay? Why have they really done it?
Well, first of all, the reason given is that there is a meeting clash. There's something else they need to go to at the same time. But obviously the other meeting, a GCC meeting, was known about. So, you know, it is interesting that they've chosen to delay it. I think it speaks to a lot of the difficulties that OPEC faces. They need to... You know, you're looking at a market next year that's going to is widely expected to be oversupplied next year, million and a half barrels a day, something like that, if OPEC doesn't add supply. So if they do add supply, clearly there's a chance that that's going to be interpreted bearishly by traders. So they have to be very careful. There's pressure from within OPEC to add supply. Some countries, for example, the UAE, have added capacity. They've, you know, pushed hard to be able to add supply. They want to do it. So it's not as simple as, oh, well, we're just going to delay. Because also all of the OPEC members who aren't pumping more are giving market share to somebody else. So there are all those dynamics, more supply coming and a need from within to pump more barrels. Now, that needs some careful thought, some negotiation, some back and forth between the key kind of decision makers within OPEC, and presumably that little bit of extra time will give them a chance to kind of think about what they want to do, the messaging that they want to deliver, and all those things.
Yeah, so why is Brent up today? It's up 0.5% at the moment. Is it because traders are expecting a deal to come out of this meeting?
Well, I think there's a few things. One is it's Thanksgiving, so thin volumes. so thin volumes. So it's hard to read too much into today's pricing. Full stop. And then, I think there's a growing expectation, a growing realization that it will be hard for OPEC to bring that extra supply on next year. Now, the delay of the meeting maybe just makes that even more of a kind of a thought in the market's mind. Maybe they have to kind of hold back and wait a bit longer to re-add the supply, which they are supposed to do early next year.
Yeah, I mean, you talk about the supply challenges and the decision on that side, but do you want to lay out some of the challenges on the demand side? Of course, China not growing as fast is one aspect.
Absolutely. I mean, we reported today a really interesting piece from our colleagues in Asia, as well as the economy, which is the important thing. But our colleagues in Asia did a great story about the EV expansion. There's a huge growth in EVs in China, having a crossing of the lines between EVs and gasoline-powered cars. So as that happens, you're having A, a weaker economy, and B, the demand for road transport is being met increasingly by EVs, and therefore you're eroding an important source of demand, which is gasoline in China. So economy and change in the makeup of demand.
Yeah, really interesting. We also have a story about US motorists needing to brace for a hike in gasoline prices under the incoming Trump administration because of potential tariffs on imports of products from Canada and Mexico. So another element in this story. Al Nightingale, good to have you with me around the table as we look towards that OPEC Plus meeting, delayed as it will be, but December the 5th, the new date, and Brent now stronger 0.5% at $73 a barrel. Thanks, Al. Just checking in on these broader markets as things stand. We have the Stock 600 higher 0.6%. It's green across the screen for European equities this Thanksgiving. Thin volumes, as he mentioned, for equities as well. The FTSE 100 higher 0.1%. The CAC 40 actually managing to eke out gains of 0.8% despite the political turmoil in Paris. And although we have equities closed stateside, futures are pointing higher. S&P E-mini futures higher 0.2%. Just flipping cross asset, despite the turmoil, we have euro dollar only weaker 0.2% at a 105 handle, but lots of speculation about potential euro dollar parity. The 10-year boat yield weaker 6 basis points at 2.9%. And we can discuss it all next with Patrick Armstrong from Pluralmeet Wealth on the programme. That's next. This is Bloomberg.
Leader in technology for as long as you have been. Do you think AI is just as landscape changing as everyone else seems to think it is?
Sometimes things are overhyped. I don't think that AI is overhyped.
I think Etsy's uniquely...
You're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. they're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome back to Bloomberg Markets. I'm Lizzie Burden in London, where it's just coming up to 3 p.m, 10 a.m. stateside in New York. And of course, it's Thanksgiving, so happy holidays if you're celebrating. It means that markets are closed in the US and it's thin volumes elsewhere. But we are looking at the Stock 600 currently higher 0.5%. Green across the screen for European equities. Even in Paris, the CAC 40 higher 0.7% despite the political turmoil. And when you look at it by sector, break it down, and you've got about 3/4 in the green. Tech leading the gains still, higher 1.25%. Consumer products and services, though, bottom of the basket, down about 0.25%. As I say, equities are closed stateside. The rally yesterday falling off just in time for the holiday, knocked by that tech sell-off and core PCE climbing, so that kind of supports the Fed's gradual approach. But futures pointing higher. S&P E-mini futures higher 0.2%. Looking at the cross-asset picture, we have euro dollar currently weaker by 0.2%, shall we call it, 105 handle where we are at the moment. On 10-year oats, we're down 7 basis points at 2.95%. Actually, the French benchmark yield had matched Greece's for the first time ever earlier in the day, but it's lower now given the concessions from the French finance minister. Brent trading at $73 a barrel, stronger 0.4%. OPEC Plus having delayed its meeting to December the 5th. And gold trading at $2,642 an ounce, stronger 0.25%. That's a look at the broader markets. Let's get some context now. We can speak to the Plurimi Wealth CIO, Patrick Armstrong, who's always got a view on these things. Patrick, good to have you with me. We've got the appointments and the Truth Social posts rolling in from Donald Trump. We're getting a bit more of an idea about how he campaigned is going to translate into how he's going to govern. So I wonder how President-elect Trump is going to both get the deficit down and cut taxes.
Well, he's going to forecast incredible growth, or strong growth, as he'll call it, very strong growth, and that allows the budget math to work. So Besant's talking about 3% growth and reducing the deficit to 3%. And those projections will make sense if you achieve the growth, which will be difficult to do. But I think that's going to be a bit of a pie-in-the-sky type thing where the budget, assuming massive growth, that kind of growth isn't going to be easy to achieve. I do think the deficits are going to stay wide, which will be pro-growth, but you're not going to get to that 3.33 that's being targeted about real GDP growth of 3% and keeping the deficit down at 3. The tariffs, I think, are an opening gambit, and the reality won't be as harsh as the rhetoric, but I could be surprised on that. Obviously, no one knows for sure with Trump. What seems like rhetoric may turn into official policy as well.
Okay, so an opening gambit, maybe just a negotiating tactic when it comes to tariffs. I wonder, where we've got Scott Bessent picked for US Treasury Secretary, what you think his relationship with the Fed's going to be like. Of course, previously he's talked about having a shadow chair as a form of forward guidance. Does that kind of water down Powell's power on the future path for rates?
I don't know if it does, but that will be very attractive to President-elect Trump, because undermining the Fed, as long as his message is getting through to them, will be very important. President Trump thinks He knows best, and he's stated that openly that he shouldn't be calling the shots at the Fed, but he should have that dialogue with the Fed to indicate what he thinks rates should be. Having a shadow Fed may undermine and create potential for criticism of the Fed at a minimum. And it won't be surprising anyone to see a bit of effort from the Trump administration to influence rates, as that's going to be part of their agenda, their pro-growth policies.
So how do you position around all this? We've got Thanksgiving today. It usually kicks off a Santa rally. Is that what you're expecting into year end?
I do think equities keep moving higher to year-end. I don't think there's going to be much to rock the boat in terms of a year-end rally. It is realistic to be optimistic on growth, and equities are the way you play growth. Trump's policies are unequivocally pro-growth apart from tariffs. The stock market's going to be one of the key metrics he measures himself with. So most of what he does is very stock market friendly. Deregulation, pro-growth policies, probably tax cuts are going to be pushed in as well. All of that should set the stage for a grind higher in risk assets, and you still have a Fed that I expect another cut from in December. So a cutting Fed with a positive economic backdrop sets a pretty good environment for equities heading into year end.
Okay, I'm interested in how it all reads across, though, to Europe. Are you expecting an actual trade war? You said previously that the tariffs are maybe just a negotiating tactic. Do you see this kind of Mexican standoff between US and European retaliatory tariffs?
I think Europe will respond immediately once it goes beyond a true social or a tweet where there is an explicit policy. I suspect Europe will, for the early days, react as one unit. They won't be surprised by tariffs. They won't be surprised by policies that are very nationalistic. In 2017, maybe they were a little bit disjointed in responses. So I do think as soon as there's a clear proposed policy, Europe will have a clear counter policy, and we'll see if that leads to, hopefully, a productive dialogue that doesn't result in trade wars. But from where we are today to where we will be in the next 3 or 4 years from now, trade will have curtailments to it from tariffs and nationalistic policies. It's just a question of how extreme those policies are at this point.
Will we get euro-dollar parity before the end of the year?
No, I don't see that happening, but we are going to go into an environment where the Fed probably won't be able to cut as much as the market's expecting, or it has been expecting recently, but the ECB will have a wave of cuts throughout 2025, and that should lead to dollar strength. And if you are in an environment where there are currency wars, one of the best levers you have and the best weapons you have in a trade war is your currency. So I don't think Europe is really going to fight a weaker euro, given some of the headwinds from tariffs that might potentially come. Trade wars, you want a weak currency, and that basically offsets some of the sting from tariffs as well.
Okay, certainly something that Christine Lagarde is going to be keeping an eye on, the exchange rate impact of Trump's policy on the ECB. Pluribee Wealth CIO Patrick Armstrong, always good to talk to you. Thanks for joining us this Thanksgiving. Happy holidays to you. But coming up on the programme, US regulators have turned their focus to Microsoft with a wide-ranging investigation into its offerings from AI to cloud computing. What does it mean for the company? We'll bring you the details next. This is Bloomberg.
There's a lot of fears around AI. AI is not technologically neutral, right? The splitting of the atom is not technologically neutral. There's implications.
Hi, Tomo. Hey there, Emily. You have machines that say, I love you. I care about you. I'm your friend.
I'm a human, not an AI. You can't just shut me down. Who do you think you are?
I'm Emily Chang. Welcome to Posthuman.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The top names at the Fed are on Bloomberg.
You know, the economy's in a very good place right now. Inflation's coming back down to target. The labor markets are healthy. We're seeing solid growth. I think we're well positioned. I certainly wouldn't take another ease in December off the table. But again, we're not on a preset path. And so we'll have to look carefully at the data and see what makes sense when we get to December 18th.
Nobody covers the Fed like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Welcome back to Bloomberg Markets. To tech now, the US FTC has opened an antitrust investigation of Microsoft. It's going to be drilling into everything from the company's cloud computing and software licensing businesses to cybersecurity and its AI products as well. Sources say that the demand, which is hundreds of pages long, has been sent to the company after the FTC, the Federal Trade Commission Chair Lina Khan, signed it off. Well, let's get analysis of what it actually means by Bloomberg's Peter Elstrom, who joins me now round the table. Peter, this is being seen as a kind of parting shot from Lina Khan. But then, of course, Donald Trump's been said we can expect some lighter regulation from him. So I wonder if you were Microsoft, how worried you would be about this.
Yeah, well, we're seeing the Biden administration now trying to wrap up a few of the initiatives that they've taken over the past 4 years. They realize the Republican administration is coming in, and they're trying to finish some of these things. On the tech front in particular, we're worried about some of the export controls. And now we've got these antitrust investigations coming out of the FTC and the Justice Department. This is a quite aggressive look at Microsoft from Lina Khan. Lina Khan has really led the effort against big tech in a number of different fronts. They've gone after Google, they've gone after a number of other companies, and now we're seeing the focus really on Microsoft. The concern here is whether the company is wrapping a bunch of its services together to give itself some kind of advantage. That includes their cloud computing services, which are very important these days, their artificial intelligence services, where they're aligned with OpenAI, the company behind ChatGPT, and also their cybersecurity services, which are very important, very widely used, and the federal government is, in fact, one of their customers. So this is an aggressive look. This is a Bloomberg exclusive story, and they tell us that Lina Khan and her team have been looking into this for about a year at this point, and they're now going to the company trying to get answers for some of these concerns from their business partners and from their customers.
Well, as you say, it's not the only thing that the FTC has been up to. Uber also facing a probe on its subscription service. How damaging is that for Uber?
Well, it's, again, this is just the beginning of it, but the Uber One subscription is something that people pay. They pay a monthly fee of about $10, $100 a year. And the concern here from the FTC is that it may be a bit difficult to cancel those subscriptions. This is a common practice of many American companies, unfortunately, where once you sign up for something and you're getting that credit card billing statement every month, it's hard to cancel it in the end. So they want Uber to do a better job of making it easy to cancel. Uber, for its part, says that it only takes takes about 20 seconds to cancel, so there's got to be some common ground here that they find.
I've lost track of the subscriptions that I have running all at once. Just finally, I want to ask you about this meeting between Mark Zuckerberg, the Meta CEO, and Donald Trump over at Mar-a-Lago. What are we meant to read into this about how their relationship's going? I can't forget when in the Emily Chang documentary, Zuck described Trump as a badass for going like this after getting shot.
That's right. Well, I don't think Mark Zuckerberg is looking for a position in the White House. It was 4 years ago that Facebook actually banned Trump from the platform. I think right now you're seeing a lot of business leaders trying to build relationships with the Trump administration. Some have the kind of profile where they can go directly to Trump. Some people are going for other executives within the administration, senior people within the administration. I think everybody is looking at the ground that Elon Musk has taken within the administration, seeing how prominent he is, what kind of prominence he has within the leaders there. And they would like to have that kind of relationship as the Trump administration comes in and begins to change what's anticipated to be many policies across the board.
Yeah, you got to feel threatened maybe if you were Mark Zuckerberg watching one of your biggest rivals in tech getting so cozy with the president-elect.
Yeah, and Republicans have gone after social media in particular very aggressively so far.
All right, Bloomberg's Peter Elstrom, thank you so much for giving us that context. And we're going to stay with tech because meanwhile, shares of Chinese driverless tech firm Pony AI have fallen in its US trading debut after an early pop. Bloomberg was speaking to the CEO and co-founder James Peng about their growth strategy amid the rising tech and trade tensions between Washington and Beijing.
In terms of the sanctions on the chips, actually for us, it's nothing new. We have dealt with this for quite some time already. So for our strategy was and remains to be that we will diversify our supply chain. And I think as the more and more manufacturings of the chips coming out from either in China or rest of the world, we'll try to have more diversified supply chain to further de-risk our exposure to the geopolitical tensions.
Hi, James. This is Steve Engel here. We met, I believe, at the Beijing Auto Show earlier this year. And I did take a ride in one of your LiDAR and Pony AI-equipped Toyota robocabs in Beijing. I do understand that, you're a company that had some robo trials in the Bay Area, but also in multiple cities in China. So you kind of have, influence in both the United States and China, obviously. But what was the main questions as you took your company public in New York? What was the main concerns, if you will, of potential investors when you went on that roadshow in the United States with increased geopolitical tensions?
Surprising, actually, the geopolitical tension questions wasn't at the front and center of the investors, but rather the investors more focused on the economical side of the robotaxi. People are really interested in figuring out when will be a time for the robotaxi to be actually large-scaled, deployed, and be profitable. So I think the good news is that people really believing that 0 to 1 has already finished, and now it's the time for the autonomous driving companies to really go to the large-scale commercialization.
What does that look like exactly, James? Because right now you're operational in 4 of the top or tier 1 cities, but what does that actually look like, say, over the coming 1 to 2 years? I know that you're going to continue to focus your efforts primarily in China, but talk to us about the competitive pressures that you face there as well.
Yes, our especially if you're talking about the next 2 years, our main focus will be on the tier 1 cities of China, and actually just this year we also signed a deal with Beijing Auto and Guangzhou Auto to mass produce autonomous driving vehicles. So that means in the next 2 years, we'll have at least 3 models coming out of the assembly line will be launched into the tier 1 cities in China. So I think with the support of further support of the regulations and the residents actually get more familiar with our services, I think we'll have a much larger fleet, have a bigger coverage, and hopefully we'll be able to actually have a much larger scale commercialization.
So that was James Peng, co-founder and CEO of Pony AI, speaking to the Bloomberg China show. And still ahead on Bloomberg Markets, we're going to turn to the Middle East and a moment of peace. We'll look at the truce between Israel and Hezbollah, whether it can last and whether it will be the foundation for a broader peace for Gaza. Stay with us. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
As we spend some time here on the broader presidential race,